energy company missing estimates, so we'll watch that one at the open. And also keep an eye on the healthcare company PureTech. It's in talks with Nordic Capital Epsilon on a possible cash offer, this according to a statement. Guy.
Okay, let's go top down. Let's figure out what's happening. It's time for the opening trade. Yesterday was a crazy session. What are we about to see? We're expecting markets to open in positive territory. Equity markets, cash equity markets, and we're getting that from the FTSE 100. We're up by 0.2% at the moment. How much higher do we go? How much volatility do we see in the session? The VIX is going to open in around 15 minutes' time. We'll get a temperature check on what is happening with the market at that point as well. Stock 600 is up by 0.7%. The IBEX is up by 1.2%. We are seeing some green on the screen. Feels like a long time ago that this last happened to European markets at the open. So we've got a positive session. The CAC is out of the gate fairly quickly. We're up by 1.6%. So some green. Anna and Chrissy, what does that mean in terms of the sector story? What's coming back most strongly?
Well, it is, to your point, you are seeing a bit of breadth. I was expecting most of the stocks, actually all of the stocks, to be in the green, that buy across the board. You were not seeing that element. From an equities perspective, your laggard this morning is utilities, but everywhere else is green on the screen. When you look at index contributions, tech is leading the charge. I'm looking at ASML, Schneider Electric, SAP. Those seem to be the big movers to the upside, but then your big kind of commodity names as well. If you're a large cap in Europe, Anna, this morning, you are rallying.
Right. I mean, I was looking at some of the sectors that have done well month to date, and we do see a bit of a reversal in that. So utilities, grocery stores, real estate, these were all doing pretty well month to date. That's on the back of fears around recession and going into some of the bond proxies, perhaps. And, you know, we're still going to need to buy groceries and some food and some beverages, it would seem. So those were the trends. And so we're seeing some reversal of that this morning, but it only scratches the surface, really, doesn't it, compared to the losses that we've seen of the last few days. Yeah. Energy stocks on that same theme, month to date, they were an underperformer because of the links with growth, and energy is the best performing today as oil prices bounced by just 1%.
458 stocks up, down 76, unchanged 65. There's a story just crossed the terminal which I thought was quite interesting. Porsche's Q1 China deliveries down 41% year on year. That's a number worth paying attention to.
Yes, for Q2.
And that's the before of the announcements, right?
Anyway, the stock is, the autos have been so battered, the stock is tracking a little bit higher this morning. But we are certainly seeing a much more positive market. It's unsurprising that the outperformers recently, the safe havens, the utilities are doing better, are doing worse today after having done so much better. But it's a fairly eclectic mix in terms of where we're seeing the percentage gains coming through at the upside. But from a points point of view, ASML, Shell, Roche, Novo that are coming back the most strongly. These are sectors that have been battered recently.
Coming on pretty strongly, but I mean, these moves are pretty, to Anna's point, not as big as the losses that we've seen, but these moves are pretty decent. We're looking at an ASML move here of just shy of 4%. That is a pretty gigantic move that we are seeing this morning. Let's see if it sticks. I'm going to ask the true expert, George Debas, head of European equity and derivative strategy over at BNP Paribas Markets 360, joins us around the table. He's had a quiet couple of days, so naturally we bring him on the show. George, we keep hearing, Emmanuel Cao from Barclays this morning had made the comment on Bloomberg TV that there is no put on Trump. How do you trade a market that has no Trump put?
It's very difficult to trade a market when a lot of it is dependent most probably on a single individual, which by nature is quite unpredictable. So it puts us a bit in a difficult situation. It becomes a lot easier if you're a long-term investor and you want to actually start buying stocks that have derated a lot, that are attractive, like ASML, all while understanding that on the short term, you might allow yourself for a bit more volatility. But as long as there is uncertainty in the market, I think it's a bit more prudent to be cautious and hence have a bit more allocation to defensive, either indices or sectors or companies, than necessarily trying to go full-blown and buying the stocks that have completely derated on the short term.
So I've heard in some of the commentary in the aftermath of this kind of market carnage that we've seen that there's going to be not just a structural shift in the global economy off of these tariffs, but a structural shift in the way that the stock market not only operates, but the companies that have been kind of having that leadership. In the absence of this structural shift, or in the time that it takes, why not buy every dip?
Well, the current issue that we're currently having and that investors are facing is a rising risk of a recession. And that is stemming from an uncertain environment which is led by a paralysis because investors and also corporates are not really willing to do bigger investments as long as there's no real clarity around what's happening with the trade tariff. So with that uncertainties happening brings a lack of confidence in investing, which also brings a lack of growth with it, on top of the direct effect that you have from trade tariff. So in that environment, you have a probability of fundamentals going a bit lower. And as long as fundamentals are holding up, it's fine to buy the dip. But if they start turning south and you have negative earnings revision and also negative GDP, then the downside scenario, especially if we do actually enter a real recession, is quite material.
Let's talk a bit about the volatility we're seeing in markets then, Georges. And I was looking at the VIX. It's higher now than it got to during the financial crisis. It is closing in on COVID levels.
Correct.
The VIX. I mean, looking at the futures curve, colleagues pointing out that suggests that volatility could be here to stay. It's not going away quickly.
Yes.
What's your assessment?
I would agree with them. I would say the velocity of the market reaction post-Labor Day has been so big. So I'll give you just a quick stat. The S&P 2 days downgrade and Eurostoxx, the 3 days downgrades, have only happened during Black Mondays, Lehman Brothers, and COVID. These are 3 very big days. So in that respect, VIX and volatility tends to react to spot, and spot's reaction has been quite extreme. So it does make sense the volatility has reacted the way it did. We do expect it to remain elevated in the sense that as long as there is unpredictability, there's no reason for volatility to come down. But would it remain at these levels? It's going to be a bit difficult in my view.
Difficult for it to remain up there.
Up there.
Yes.
Elevated, yes, but at these levels,
Because recent spikes in the VIX seem to have been unwound pretty quickly, or
Correct.
increasingly quickly, seems to be the message coming through from our derivative strategists here at Bloomberg. What do you observe in how quickly the VIX recovers?
So within the VIX, actually, if you look at history around these type of shocks that happens, where the VIX and the VSTOXX are these type of levels, a month, 2 or 3 after, you tend to have a reversal 5 times out of 6. So you're right. Spot, on the other hand, could drift continuously lower. So you could have continuous market reaction, but not necessarily with volatility that increases from these levels. What we've seen from both our position indicator and also from, maybe anecdotally, from the flow that we've seen internally, are indeed that we've seen more people coming to unwind some of their hedges, selling some of the volatility, than increasing their activity and the hedges at these levels. So we haven't really seen panic, as you would usually have seen when VIX is at these levels or VSTOXX are at these levels. We've seen the other,
Good to know this isn't panic then.
Yeah. So what's demand for hedging like? And I'm assuming a lot of it's puts. Talk me through what you've seen.
So we've seen more unwind of hedging than desire for new hedging.
Okay.
So what has happened, in our view, is post-Liberation Day, the market has realized the probability of recession, or maybe taken to Trump administration more seriously, has materialized. And so there was correction in the probability of recession. Entering into the event, the probability of recession was too low, because at the end of the day, the impact on the economy and the tit-for-tat retaliation is something that was expected. But as soon as people finally understood that now it needs to feed into your probability numbers, it allowed a market reaction where investors decided to degrow some of their risk book. Because coming into the event, most investors were still long equity market. I mean, it was only 2 months ago we were sitting here talking about U.S. exceptionalism. And 2 months later, we're talking about recession.
So the market doesn't feel, given the potential for this to escalate, that it needs to hedge some of that risk still? That risk has been, we've moved through that event, and we're post that event, and it's now, you basically reorganize your portfolio.
I think a lot of the reorganization has already happened.
Okay.
And most of the investors that we've talked with were already starting to hedge pre the event.
Right.
Not post the event. They've allowed this event
But does that imply that they don't think that it's going to, that there are not big risk events still to come? That the worst of the risk event is now over?
No, I think, sorry, let me rephrase that.
Yeah.
The risk events are still very much present, but because they're very much dependent on one person that can relatively change the narrative very quickly, given that this is a crisis of confidence, it's not one of over-leverage in the system or systematic issues, we can change the narrative very quickly.
Not all Americans know that the U.S. and Russia are actually much closer to each other, just 2.
You need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
This is the opening trade. We're at 30 minutes into today's session, seeing green on the screen, a rebound across these markets, but not to the same extent that you saw the sell-off. It is worth noting that the Stock 600 higher by about 1.5%. Outperformance, no surprise, in the DAX and the CAC Iran. Does that actually stay put, though? Yesterday, about 24 hours ago, we were looking at this market and saying there's not one stock in the green. That kind of rebound doesn't have the same breadth to it that the sell-off did, and I think that's pretty consequential.
It's a bounce. Describe the bounce. I don't know how you would describe it. People will talk about dead cats. People will talk about this being just a response to yesterday. I don't know. Has something fundamentally changed? Has something got better or worse? I don't know either. We're certainly waiting to find out what the various responses are going to be around the world. We've talked already significantly about what is going to be happening a little bit later, potentially with China. Let's talk a little bit about what's happening with the European Union. Their trade ministers have closed ranks, signals a readiness maybe to deploy a full spectrum of countermeasures to the United States, including potential taxes on digital companies. This, of course, in response to President Trump's tariffs.
Everything is possible. Everything is possible. We have a wide toolbox, and everything is possible. And at the end of the day, we don't want to use it, but we can use it. And this is, I think, what was most consensual.
I hope Mr. Trump is smart enough to know that our economies are very much connected and that we depend on each other, and that tariffs are very bad for all of us.
I know that 27 are stronger than 1, and so if we keep united like we do for the moment, I'm trustful that at the end of the day we'll find a good compromise.
How united is Europe right now? Different views seem to be being expressed in different capitals around the continent. Europe doesn't feel ready to maybe go down the road that China has gone down at this point. Let's get a sense of where we are in this journey. Oliver Crook joins us now to talk us through what we got yesterday. Was there a breakthrough yesterday, or are we still hedging our bets within the European Union, Ollie?
Yeah, I think hedging the bets is the right way to put it, Guy. I think at the moment what you're seeing is you kind of have the spectrum of sort of China on the one end, the UK on the other, and the EU kind of trying to play slightly closer to the sort of UK side of things, whereas China's going sort of all in, retaliating against the United States. You're seeing the same thing sort of in Canada. EU is really trying to give himself maximum flexibility. What we understand from the conversations yesterday is you have Plan A and you have Plan B. Plan A is to negotiate, to try to bring things to the table and basically not escalate the situation. You heard the term de-escalation from most of the trade ministers you spoke to, but when you press those trade ministers, and I asked them, a number of them, do you have any idea what exactly the United States wants from the EU, what the non-monetary trade barriers are? They say, no, not really. Have you had any contact? Has there been any sort of willingness from the United States side to negotiate? They say not really, which brings us to the Plan B, which is the full sort of retaliation and the menu of options there. What those could include, we've talked about them before, are basically taxes on the U.S. tech company, the so-called anti-coercion instrument, that sort of piece of legislation here in Europe, which is sort of the nuclear option on trade that they could deploy. But what we are expecting now is to have some slight retaliatory measures. That's just to the aluminum and steel coming into force next week. That is going to be pretty modest. But again, I think what I was most struck by in talking to these trade ministers is how little contact there is right now between the United States and the EU in terms of negotiating any sort of deal on tariffs.
So, Ollie, in this market, when they're digesting all these headlines coming from the European Union and around the world, there's an argument that good news in this market can come in the form of retaliatory tariffs that are not as strong as the ones that Donald Trump imposed on the rest of the world. Where does the EU stand on that? Are we seeing any element of retaliating with less than expected?
So you're seeing a little bit of signs of that just in terms of how they're going to approach the steel and aluminum tariffs. I think that'll be pretty interesting as we've been reporting overnight. Bourbon has apparently been axed off of the list, but we do expect there to be measures on things like motorcycles, diamonds, boats, household appliances, tobacco, poultry, those sorts of things. Those will come into force next week. What is also interesting is despite the fact that these tariffs will come into force on April the 15th, they're not going to actually start collecting them until May, right? So this is sort of the whole idea of giving as much ample opportunity, as much runway to negotiate. But again, I think what is going to be very sort of decisive in all of these conversations, both for the Trump side and for the European side, are the markets. Are the markets going to push either Trump to the negotiating table, have a little bit more strength to the EU side? I asked a number of the ministers if they think the markets are on their sides. When you see these sort of huge drops that we've seen over the last few days, they wouldn't really sort of be, bite on that. But I think that is going to be the fundamental reality and the dynamic of who needs to come to the negotiating table, and everybody right now is just waiting.
Oliver, thank you very much. Bloomberg's Oliver Crook with the latest on the tariff conversation, how it's playing out in Europe, what Europe is responding to and what it is not. Let's think about the market's reaction function to tariff news. Edward Kolb, multi-strategy equities head at Man Group, joins us. Ed, very nice to have you with us this morning. I just want to get your sense of the latest signals that we're getting, because yesterday's price action made it clear that the market is really clinging to all messaging around tariffs. So we jumped higher on the speculation we might get some kind of pause. Then that was denied by the White House and stocks dropped. So with that in mind, I'm drawn to some of the clues we're getting about whether this is to be negotiated away or not. And we heard from Scott Bessent talking about, the US administration is talking to lots of countries here, tens of countries. But then Peter Navarro saying this is not a negotiation. What is it that the Trump administration can say about tariffs and negotiations that will calm markets, do you think?
I think the first thing we all have to embrace is humility. The range of possible outcomes here is enormous. This is a thunderbolt, right? I mean, this is not what we're used to receiving as a signal from markets, and that means that the range of scenarios is absolutely enormous. I think it's probable, as your report is saying, that negotiation is a big part of this, but we have to keep an open mind that in the end this is punitive rather than about negotiation. The way I think I'm thinking about this is that there is one person whose policy matters here and one person only, and that is Donald Trump himself. So all of these other policymakers that we hear, all of the other actors in the US administration that are kind of floating trial balloons about a potential change in direction in policy, my view would be you ignore them. They don't matter, right? And a really interesting way to think about that is to think about the analogy of China for the last 3 years, which has been trying to stimulate its economy and stabilize it. We've had 3 years of relatively minor policymakers telling us about stimulus, and none of it mattered until the big man stood up and said it, right? And I think that's the world we're in today, which is as long as Trump is calling the shots on the direction of policy, and it seems to be the case that he decided very, very late in the day about how universal these tariffs would be. That was him. As long as that's the case, and I think it will remain the case, I would be a bit tempted to fade the idea that there's a rollback and that's being communicated by other members of the administration.
Okay.
As to the price action, I mean, the way we look at this is the markets are because of the thunderbolt, markets are in full capitulatory mode, right? We've had a complete, from an economic perspective, a shift in policy that breaks down 50 years of global order and 35 years of trading arrangements. That is being discounted in a disorderly way by markets to some extent. That when you get capitulation, and there are various ways of looking at it, and we've got some pretty good measures that suggest this is as extreme as COVID, when things got really, really messy in that week in March in COVID. Yeah. When you get capitulation like that, it's not unusual then for things to become very, very volatile the other way, right? Because you've had this sort of extraordinary purging of positions. Things become kind of quote unquote clean because there's been an overreaction. overreaction to some extent. We don't quite know what we've overreacted to yet. And then at which point the sort of sensitivity and the sensitivity to headlines becomes extreme.
This feels like we're going to go through various phases, though. And I don't know which phase we're in and kind of how many more phases there are to come. Goldman Sachs is out with a nice note this morning. Peter Oppenheimer and Sharon Bale talking about the fact that we're currently in an event-driven bear market. So we're very reactive to what is going on around us. But we've not yet gotten into a cyclical bear market, but we could get into that as a result of where we are now. And that's a different kind of phase that we would enter. Is that a fair way of describing kind of where we are? At the moment, we're really reactive. But as we start to get structural change, then a recession becomes a greater probability. And that's a more manageable, understandable, but not necessarily less damaging event that we could, or maybe more damaging event that we could ultimately get into. Is that how you see things progressing?
Yeah, I think that's a reasonable way of thinking about it. I mean, where we are today is panic and reaction, maybe to some extent overreaction. And where we're going, I fear, sort of almost irrespective of whether Trump reverses or not.
Yep, I mean, exactly.
Look, I don't believe he is going to return to where we were before Wednesday last week. So bearing in mind the probability that there will be some degree of lasting disruption to the way the world's economic order functions, it is probable now that we're going to have a recession. The major mechanism, I think, is going to be at play here. I mean, there's some really deeply painful things that are going to happen, right? I think you think about really undeveloped nations, which is not typically what we think about in financial markets, but there are countries now with big trade deficits big trade surpluses versus the US, whose government tax revenues are all dependent on excise duties. They're now going to have to try and fund themselves. That's really going to be a human catastrophe. Closer to home, in developed economies, we're going to have to think about the fact that opacity in the corporate sector is as elevated as we can imagine it, right? I've used this word thunderbolt, but like think about thunderbolts we've had in the past. Think about the GFC. What happened during that period was that all governments everywhere in the world came together to cooperate. We had central bank swap lines to make sure that markets stayed liquid. We had coordination on fiscal policy. We had coordination on bad asset relief. COVID was the fastest imaginable coordinated response. I mean, the way that the Fed stepped in March 2023 in a coordinated, March 2020, in a coordinated way with other central banks to buy assets, to backstop markets, was extraordinary in its speed and coordination. We're now in a world which is not going to be coordinated. This is multipolarity. And so I think that the danger here is that the opacity that businesses are facing, where the return they expect to make on capital, the questions they have about whether they have enough inventory, the questions they have about whether or not their capital stock is located in the right place, the impact that has on margins, the impact that has on the return they make on capital, all of these things, I suspect, are going to force them to shed labour. And that's pain for households, right? And that ultimately is the kind of thing that drags the world down into a recession. So I'm a bit concerned, and hopefully this is just the cortisol of the last week talking, but I am a bit concerned that it's going to be too late to put the genie back in the bottle.
You paint a grim picture, I have to admit. But I think if there's a positive sense in this, and you mentioned it yourself, is that the markets have been quite orderly about this. And we've heard that time and time again from every guest that we've heard. You draw the COVID example of this fact that you had so much liquidity support from every corner of the world. What is the tell for you that the system at its core is showing cracks?
Yeah, I mean, it's a good point. Everything we can see, and you know, we trade an enormous amount of dollar notional, and our trading desk tells us that things are orderly and we can transact. And so that's a good thing, right? Markets are working. I think that, you know, everyone will be on the lookout for bodies. These are typically the sorts of event where after a period of time, some kind of body floats to the surface. And obviously so far there's nothing. But really, I guess the things we look at are, you know, liquidity, the sort of depth of markets, the bid-offer spreads to get a sense of, you know, how much things are widening in order to transact, and then credit as well, your ability or not in less liquid markets to transact. And at the moment, you know, things are pretty orderly. So I think it's a testament to things functioning. So that's good, because we don't seem to be in a systemic crisis from a markets perspective, and that would obviously, if that occurs, that spills over to worsen my grim picture of what can happen for the economy.
We have to end the show with a little bit of positivity. You're getting towards the end of it. Thank God for you. Ed Cole, multi-strategy equities head at Man Group. Painting a grim picture, a little worried about what comes next, but saying whatever it is, the markets can survive and are pricing it.
Yes, and what you might need to survive is our show, all shows on Bloomberg TV, and a newsletter about markets. That might help. So you might want to check out the Markets Daily newsletter from Bloomberg. It's what's happening in stocks, bonds, currencies, and commodities right now. It's also where they are going next, of course. Sign up for that at bloomberg.com/newsletters.
Okay, let's talk about some of the areas that we're watching in terms of the sector story yesterday. Yesterday was unbelievable. This time yesterday, defense stocks were being absolutely battered. Today we see something of a rebound, but not enough really to compensate for the moves that we saw yesterday. But such volatility. And this is an area in theory that should be backstopped by huge government spending, but the market obviously had run this sector very, very hot for a few weeks, Chrissy.
Absolutely. Another sector that was getting hit very, very hard yesterday, just 24 hours ago, were the bank stocks. Today, you are seeing a little bit of a rebound, but not necessarily across the board. These are the four that got hit the hardest yesterday. UniCredit not getting on the rally as much. You're seeing that in the periphery. I'm curious to see how that all shakes out. Much more ahead. Stick with us. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
There is no precedent, to be clear, for this situation. In a normal crisis, pretty much the governments and the central banks trend to rush to bail out the market. And now, for the first time, we have the U.S. administration somewhat opposing the market. So there is no put from Trump right now. And without the put being triggered, yes, I think we can go down, and there is nothing to stop the market to price a recession.
Manuel Cao, Barclays head of European equity strategy, talking about the puts, the various puts that are out there. The Trump put, is there a Fed put? Can we navigate a big financial crisis without the Fed kind of backstopping us? I think is a really key question as we try and understand what is going on here. Let's bring in Bloomberg's Laurie Teitel and Michael Masika, who leads our EMEA equity markets and strategy coverage. Michael, I'm going to start with you. Equities are up a little bit this morning. What do you make of this?
Well, Guy, what we're hearing is it's not very convincing. Volumes are still low. There's a bounce because we had like a very sharp sell-off over the past few days.
Yep.
But at the end of the day, it's like you dip a little bit, but it's not like a proper buying the dip action that we're seeing.
And Michael, in terms of the themes that are being traded, it seems to be a sort of reverse of the themes of the month to date. So month to date, we saw anything that was growth sensitive dropping, and anything that was interest rate sensitive and could benefit from weaker growth was rising. Today we just see a little bit of a reversal of that. I mean, is there anything new in the action today? It's just a little bit of a reversal of the last few days.
No, I think it's a bit of a reversal indeed. But the past few days we have seen also like very indiscriminate selling. So you had like pretty much the whole market that was selling off. I mean, even like defensive sectors like pharma or whatever, just like everything was down and heavily down. So we're seeing a bit of reversal, of course, but at the end of the day, it's still really, really not convincing. We have a lot of the hedge funds still selling. The exposure to global equities is very high still for CTAs, for example.
Yeah.
They expected to keep selling this week, keep selling next week and over the next month. And Goldman Sachs are like about a 98 billion worth of global equities to be sold over the next month, regardless of like market price action. So it's it's not looking really great for the near term.
It's about you. a lot of optimism on this show.
Sorry.
I wasn't ready. Val, hop on in here, because in the last kind of 24, 48 hours, we've heard so much from so many people saying that the equity markets are following the credit story more. That's in the past. Is that what drives these markets moving forward?
Oh, look, I think it very much drove the rebound today as well. We didn't see a gap wider in high-yield credit spreads at the European Open. You know, they gapped narrower, so I think that's what helping the bank stocks rebound. But, I mean, I would just remind everybody that during a time of crisis, sometimes the up days are even more confusing as the down days. You know, it's definitely not out of whack that we would see a very positive rebound after a big equity market slide. I mean, if you look back at history, sometimes the biggest rallies in the equity market take place right after the biggest falls. So, you know, this could be, to Michael's point, you know, the calm before the storm continues.
Okay, let's talk about where potentially the next storm could come from, and let's talk about China. Trump is saying that Chinese tariffs, the response to the response, I don't know where we are, but basically
over 100%,
yeah,
I think.
Basically, there's the possibility of China tariffs going to north of 100% today if we don't see the Chinese removing the 34% they put on, which was in response to the reciprocal tariffs which were added by Trump last week. Is that the potential next storm? And the Chinese seem to be warming up, pulling some, hinting at some big levers that they can pull as well.
Yeah, I think maybe the next stage in the storm could be a big CNH deval, a Chinese yuan deval. If we look back about the previous Trump 1.0 tariff fight, they devalued their currency by 10%. And something like that, a big one-day move in the fix, you know, let's talk over 1% devaluation in yuan, could really start to spark concerns, not just from foreigners holding Chinese assets, but foreigners holding any Asian assets, because dollar Asia really very much follows dollar CNH. If we see CNH weaken, these Asian economies who are going to be attempting to hold on to capital might see the beginnings of a capital flight when they're already dealing with the higher tariffs, you know, rolling out in March. So that's rolling out on Wednesday, excuse me. So that's one thing I'm watching, at least in the Asia session, if there's this big move on the CNH fix from the PBOC.
Michael Masika, I should say. Sorry.
We just call him Masika.
I'm going to start calling him
that's what he's known as.
It feels like our friendship has.
We need efficiency right now.
Yes, quickly. Val is talking then about like where you do want exposure and where you don't want exposure. And one of the big comments here on the show has been that a lot of the unwind that you've seen in the equity market has been an unwind of hedging very specifically, but that there's little appetite to hedge moving forward. It's kind of a just retreat from the market dynamic. Are you seeing evidence of that this is really a hedging unwind, not just in maybe the equity market, but cross asset?
Everyone was really maxed out coming into the year. The cash levels of funds are very, very low. They're still very low. There is a point where you need to deleverage. You need to protect your capital. You need to exit some of the parts of the market. We were talking earlier about like, is there a put in this market? Is there a Trump put? Is there a Fed put? Maybe there is. And we've seen yesterday, we could be one headline away from like a bounce. I mean, the fake headline yesterday was like already showing that the market is ready to buy, but we need clarity. Without the clarity, and we don't have any at the moment, that's not going to happen.
Yeah, and so I'm interested in what news flow around negotiations can be meaningful, because obviously the news of yesterday was pushed back and the market shouldn't have responded to it. But we will at some point get some news about some negotiations. Unlikely, it seems, that it comes before imposition of tariffs, but in the months after that, maybe we get news about negotiations. Japanese stocks up substantially after selling off a lot yesterday, but they made back nearly all of the losses of yesterday in today's session on news that they could be near the front of the line, the queue on negotiations. Is it that kind of news flow that's going to help?
Exactly. This is the clarity we need, because the thing is, like, once you have clarity on how much is the tariff, how much the economy is going to suffer or not suffer, then you can tell, okay, this is how I price my stocks, this is how valuations should evolve, this is where the EPS is going, and that's when you can assess your exposure.
Val, how are people thinking about the Fed put? Let's talk about the puts. At the moment, so Goldman Sachs has got this nice note. They talk about being in a reactive phase. We're reactive right now.
Definitely.
That's kind of where we are in the market, but ultimately we may end up in a recessionary phase of this, and that will be much more easy for the Fed to manage. Is the Fed just going to basically wait until it sees that kind of action before it can take any kind of remedial, before it can put the put into place?
The Fed put isn't there until we see weakness in the labor market. If you look at how the things we've heard from Fed speakers lately is that they respond to the target that's missing the most. And right now it's inflation that's missing the most, not the unemployment rate. So they're there to protect inflation until
Can we manage a financial crisis without the Fed until we get to that recession?
Well, look, if you look at the past few crises, we've always had the Fed step in immediately or during the crisis, and this is probably why we're seeing such big bruising in the equity market, because they've woken up to the reality that the Fed isn't there until we see the unemployment rate go higher. And frankly, most people think that's not going to happen until the summer.
Valerie, thank you very much indeed. Michael, thank you very much indeed as well. Valerie Teitel, EMEA Equity Markets Lead. Michael Masika, thank you very much indeed.
Coming up in just over half an hour, we're going to be speaking to the Hungarian Foreign Minister. And of course, this is interesting because the Hungarian delegation, standing aside from the rest of Europe in some of its commentary around the Trump administration and the European reaction function to tariffs. So don't miss that interview, 9:30 a.m. London time.
Of course, another one to keep an eye on. Of course, later today, we're going to speak with former U.S. Treasury Secretary Larry Summers to get his take on the tariffs and the market volatility. That conversation happening at 4:10 p.m. in London. The equity markets are higher. Let's see if they stick. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Markets bounce back, but investors remain on edge as the U.S. president sends mixed signals on the potential for tariff relief. China says it will fight the trade war to the end after Donald Trump threatens to raise its tariffs to more than 100%. And the EU proposes a 25% levy on the selection of U.S. goods, but American whiskey is spared. Plus, a little bit later in the program today, we'll also be joined by the Hungarian foreign minister for an exclusive conversation on geopolitics and trade. But first thing is first, we've had convulsions in the market for the last 4 to 5 trading days. Look, the manic moves seem to be easing somewhat. Certainly that was the case yesterday. Investors looking for dip buying opportunities while awaiting clarity on how Donald Trump's trade policies will actually play out. So I know there's still very much an appetite to understand exactly the thinking of the Trump White House, but for the moment, S&P futures gaining some 1.7%. Euro dollar also a good indicator on some of the volatility and some of the worry out there, 109.26, and then the U.S. 10-year at 4.1529. Now, in Europe, things actually seem to be settling a little bit. Again, we speak to a lot of market participants, and they say, first of all, it's very difficult to know right now the impact on the trade because we're in limbo, but also because it just takes a couple of times to shake out maybe some of the loans. Also, that needs to be looked at, that pipeline in markets. So the CAC 40 gaining some 1.5%, the DAX also gaining some 1.3%, but we've definitely seen a lot of volatility, and that surge with $10 trillion being wiped off of the markets last week. So we watch what's being done and said by the administration, and of course a lot of investors also telling us maybe it's not as bad as they thought last Friday. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, China has pledged to fight to the end on tariffs, raising the risk of a prolonged trade war between the world's 2 largest economies. Now, this comes after Donald Trump vowed to slap additional 50% import taxes on Beijing unless it withdraws its retaliation against his earlier levies. The U.S. president says he's not pausing his tariff plans.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals, and in certain cases they're going to be paying substantial tariffs.
Now, for more, let's bring in Bloomberg's Brendan Murray, who leads our trade coverage, and Waitlist, Global Chief Investment Strategist at BlackRock. So thank you both for joining us. I'm sure everyone has had quite a week so far, and we're only Tuesday. Wait, there seems to be, the markets are a little bit cooler, certainly, than what they saw in the last couple of days. Is it because they think they're buying opportunities, or they're just a bit more in a wait-and-see situation, given things are moving very fast?
It's always fun to come on Bloomberg after a day like yesterday, where S&P was jumping 7% on fake news, and 10-year yields was swinging to the tune of 30 basis points per day within the day, right? Like, it's really a remarkably volatile environment right now. Typically, a market drawdown of 20% is when investors jumping across the board to buy, but we don't think this time is it. Maybe it could be, but we're not sure. What we're seeing right now is very elevated uncertainty. There's lots of moving parts, and it's impossible to have clarity beyond the very near term. But even in the near term, it's hard to have clarity. So we're shortening our tactical investment horizon to just look at kind of the huge amount of uncertainty warranting greater risk premium right now. But the big picture of slightly longer term, the story of U.S. fundamentals still holding up, that hasn't changed. But right now, we're hunkering down in the face of extreme uncertainty.
Yeah, and Brendan, I mean, the problem is, and I've read a million copies and saying, like, look, we'll have tariffs for 5 years. Actually, no, this will end really soon. What we know is that China is probably the one with the fight in saying, look, they're fighting to the end on tariffs. And, of course, that's supporting a bit of the markets.
Yeah, exactly. So what we have here is essentially a game of chicken going on between the world's two largest economies. President Trump came out yesterday and sounded, pretty upset that China had retaliated and threatened 50%. In addition, that a lot of economists would say would more or less bring the trading relationship to a standstill. Companies would have to go elsewhere. But that is, those are levels of tariffs that would really jeopardize that trading relationship. So we'll see what Trump's response is to China kind of digging in its heels. But it's a real showdown right now, and we'll see who blinks first. But there's a lot at stake, given it's about a $500-600 billion trading relationship.
And Wei, is this thinking that actually there's been a pretty blunt reaction from Beijing? So they seem to be intending to, of course, resist this pressure from the U.S. It means that in the short term we probably don't have a deal. But does it mean that the stakes are so high that there will be some kind of compromise in the medium term?
Yeah, so this is the near-term, medium-term kind of delicate balance that I was speaking to. In the short term, it's really hard to see uncertainty dissipating very, very quickly, which is why risk premium warrants a higher level, and which is why we are more kind of neutral towards equities than we are positive over the slightly longer term. But over the long term, our belief has been and remains to be that the pain in markets, the pain in economy will solicit some sort of response, and some sort of a deal and compromise could be struck, and which is why over the slightly longer term we believe that fundamentals would prevail, and the still okay earnings in global equities, but also specifically in U.S. equities, is why we are over the 12-month horizon still overweight, but right now we are over the 3-month horizon we're neutral. But it's really important, despite the headlines flying that can be quite scary, to stay invested, because it's at times like this extreme volatility that longer-term performance are built.
Brendan, do we have an idea of how many countries actually called up the White House to say, okay, we're ready to negotiate? And there's a problem of timeline. You probably don't have enough people in the trading ministry of the U.S. to be able to deal with all of this. It takes months, if not years.
Exactly. I mean, it takes, it can take 10 years to renegotiate a trade agreement. There would be dozens of countries calling. Japan has been mentioned as one where there will be a negotiation on track. But something else happened yesterday that is probably not a good sign for countries trying to seek a deal. Israel did not get a break from its tariffs from the president. And when you look at a strategic ally like Israel, and they walked away empty-handed, that sort of sets the tone for all these others. That there's going to be it's going to be a long haul to try to get those tariffs unwound, if they can be at all, given the Trump administration needs the money as well.
So, wait, how would you think about it? I know there's a pretty funky maths or algorithms in how they calculated the tariffs, and it doesn't make a difference whether you're you're a friend or a foe, because you look at the equation, that's what they want to apply, or that's the negotiating starting point. So, again, how does this end in 2-3 months?
Well, there are multiple pieces in terms of policy dimensions that we should consider. There is tariffs, which is what we're getting right now. But what is also on the table is tax cuts and deregulation. And unlike Trump 1.0, where we got the good bits that are good for markets first, and then tariffs came, we're getting the tariffs now. And then the tax cut and deregulation are further down the line, which is why markets are kind of feeling a bit nervous right now. The big picture is that we believe tariffs are both a negotiation but also a tax revenue, because to your point, the administration needs additional kind of income to try to close the fiscal gap or not spend as much. So ultimately, we're looking at kind of a landing zone 15 roundabout, that sort of average tariffs across the board, which if the other pieces were to come through in a positive way, especially the deregulation piece and the tax cut piece, markets can still hold up. But until we get there, we're talking about a period of extreme uncertainty and hunkering down for markets. So not across the board, kind of buying into the dip right now, but our investors are eyeing opportunities in banks, for example, and tech that have been really beaten up when their fundamentals are fine.
Wait, if you look at the U.S. economy, is it already in a possible recession? Or is it given that actually it will go through a significant downturn? And what does it mean for Fed?
I would observe that the effect of tariffs is stagflationary. And if tariffs were to stay at these elevated levels, the opening gambit, then chances of a recession have increased. But we're also talking about this being kind of the starting point, but there could be walk back. But one thing I would note, if you look at yesterday's market reaction, 10-year yields, really interesting. Markets are going through extreme volatility, but 10-year yields, government bonds are not good ballast coming to the rescue of markets because of inflationary concern. So the Fed is not going to be able to come to the rescue of the economy as readily as they were able to before, and that could kind of make the economic situation even more kind of treacherous in the face of elevated tariffs.
And Brendan, I mean, there's no secret sauce, right, in how to negotiate with Donald Trump. I mean, you were mentioning Prime Minister Netanyahu. I've heard it all, like, Meloni should negotiate for Europe. We should do this. Carney has it right. Maybe we should look for how Mexico does it. Is there any insight into the Trump administration's thinking? I mean, they're saying outwardly that the markets are fine and they'll settle, but is there a sense of panic at all?
Well, the thing that the Trump administration officials have said over and over again is it's the trade deficit, and fix your trade gap with us, and we will, and that will make us think about lowering your tariffs. But the thing that I would keep an eye out on over the next several days is how China and the European Union respond to American companies in ways that don't involve tariffs. This is the time when the Chinese regulators come knocking on the door of an American company and start causing problems. There are other ways other than tariffs that can disrupt American businesses abroad. The same thing with the European Union targeting a lot of big tech companies based in the U.S.
Yeah, and I guess you could argue that over the last 15, 20 years there has been big imbalances, but this is probably not the right way to fix the trade imbalances.
To your point about the funky way of coming up with the effective tariff rates, the goal is clearly both to kind of negotiate but also to bring down trade imbalances. But it's not just goods but services as well, and I think that's a piece to consider as we think about kind of in the coming days how the different responses could look like.
Thank you both for joining us. Bloomberg's Brendan Murray, who leads our trade coverage, and Waitlist, Global Chief Investment Strategist at BlackRock. Now, EU trade ministers have closed ranks and signaled readiness to use a range of countermeasures, including potential taxes on digital companies in response to President Trump's tariffs.
Everything is possible. Everything is possible. We have a wide toolbox, and everything is possible. And at the end of the day, we don't want to use it, but we can use it. And this is, I think, what was most consensual.
I hope Mr. Trump is smart enough to know that our economies are very much connected and that we depend on each other, and that tariffs are very bad for all of us.
I know that 27 are stronger than one, and so if we keep united like we do for the moment, I'm trustful that at the end of the day we'll find a good compromise.
Well, European trade ministers speaking to Bloomberg's Oliver Crook as they met yesterday. Ollie joins us now from Brussels. So, Oliver, how much unity is there amongst the EU?
For the time being, Francine, the unity is still pretty strong in terms of the European approach to dealing with Donald Trump and the tariff response. We'll have to say that, as time goes on and the conversations get a little bit more tricky because there are different, obviously, agendas within the various different European countries, that could change. But for the time being, it's holding fairly strong. What you have right now from the European trade ministers yesterday was discussing two plans. There's Plan A, that is a negotiated outcome. That is what everybody in Europe basically would like to see. That is what everyone is basically praying for. But when you ask them, basically, does the Trump administration give any indication that they're willing to come to the negotiating table? Have you had any indication in the last few weeks? The answer is, if they're being honest, the answer is no. Do you have any idea what the Trump administration actually wants? Do you have an idea of what they mean by non-tariff barriers, the so-called monetary barriers to trade? They don't know exactly what the Trump administration would like to see change, and there's not a huge deal of communication, which takes us to Plan B. And Plan B is basically using not just tariff measures. We know that they've prepared already tariff measures, which will come into effect next week. That deals with the steel and aluminum, but basically non-tariff measures. We're talking about potential tax to services, different regulations on the U.S. tech companies. We're talking also about various other sort of sets of regulations that could make things more difficult for the United States. But for the time being, the Europeans are trying to buy as much time to create as much runway to negotiate with the United States at a point where, frankly, it doesn't seem that there's been a whole lot of contact or appetite to negotiate. That being said, the sort of trade representative Sefcovic has said that there is not a sort of unlimited timeline, and at a certain point they will be forced to act. And again, as we've heard from all the trade ministers, all of the tools are on the table, so we'll have to see how things materialize over the next few days. I suspect the markets will have a certain say in how things go. We'll have to wait to see how that pans out.
Ollie, thanks so much. Oliver Crook there in Brussels in front of that Commission building. Coming up, we'll discuss the impact of tariffs and the outlook for the real estate sector with Jonathan Goldstein, the chief executive of property investment firm Kane International. That's next, and this is Bloomberg.
loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The conversations that matter and the insights you need. This is a pulse. I'm Francine Lacqua here in London. And traders have boosted expectations for the Federal Reserve to cut rates this year. It's usually a welcome news for the real estate industry. But the recent moves have also been spurred by President Trump's sweeping tariffs, which of course threaten to boost costs and weigh on profits. And real estate is especially vulnerable because of the many kinds of materials that they need to be imported. So let's discuss the outlook with Jonathan Goldstein, the chief executive of Kane International. The firm operates in the UK, Europe, the US, and manages more than $17 billion in assets. Jonathan, thank you so much for joining us. I mean, it's, you know, when we booked this interview, we didn't know that we were in the midst of a tariff global trade war. What does it mean for real estate markets in Europe?
Look, clearly it's early days. The markets have reacted very badly to the announcements from President Trump last week. And I think the big question that the world's looking for is what is the outcome that the Americans are seeking? Are they seeking for a protectionist environment or a free trade environment? And where that ends up will very much signal the impact it has, not just on real estate, but across many, many industries. So I think people are watching day by day to see how negotiations are taking place with other countries and whether they are negotiations or whether or not the tariff board that we saw last week is what we're going to end up with. I very much believe we'll end up in negotiated positions because I think that's the pragmatic policies that I think the administration will ultimately follow. But clearly the markets are nervous and spooked in the event that that goes a different way.
Yeah, I mean, since 2022, there was a clear trend, right? It's like property yields were higher, you know, you had a fairly benign operating fundamentals and rising rates. Is there a risk that all of that could be reversed quite suddenly, or would it take time?
No, I think that the uncertainty creates two scenarios. First, it creates opportunity. You know, real estate has often been an asset class that people have run to for refuge because they see long-term value in a stable environment, countering, you know, a balance against inflation, provided you've got the right quality. So I think that we're seeing this as an opportunity now to look around the marketplace. You know, clearly there's been a significant reaction over the course of the last 4 or 5 days, and some might think it may be an overreaction to what they're hearing, and I think that what one needs to do is look through the story and try and see if there's opportunity that comes through. And with some of the quality assets that we both own and develop, in some senses, I feel more confident about those coming out of this because I think there's always a flight to quality when people see the turmoil that they've been seeing in the last week.
Jonathan, you talk about finding value. Where would you find that? Is there like a specific region or assets that you would like?
I think you have to look across the sectors, the markets that people need and people rely upon. So I think, you know, we've invested a significant amount in the luxury end of the sector, and we continue to see that as a growth sector. But it's also in the assets that people need to service their lives, be it the industrial, the logistics. You know, we see that as a considerable growth opportunity still, provided that, of course, there is a level of stability that comes out from this, both, you know, in the US, but obviously reaching out, as you were listening to with your correspondent before, in Europe, but also into the UK as well.
Jonathan, where do you see, in terms of segments of the markets, the ones that are most exposed or most protected?
Well, I think the most protected are those with quality and locations. I've always felt that the most nervous aspects are those where you're investing in areas which are not prime locations.
But commercial, or does it commercial or holidays?
Well, the secondary office space has always been an area for the last, since the pandemic, which has really suffered because people want a flight to quality. People want to invite people back to their offices and see quality in it, just like we've got in the Bloomberg studios here. So I think that's always been the area that people have been nervous about. And if you've seen across America, swathes of portfolios being handed back to banks over the course of the last few years because there are no takers for these places.
What happens to the logistics business?
Well, I think, again, it comes back to supply and demand, and it comes back to the issue of tariffs and how goods move freely around the world. So in some senses, it's very difficult to call at this point in time. But ultimately, you have to believe that the progress that we've seen, the online changes that we've seen, the data centers that we've seen growing, that is a trend that will continue, notwithstanding the noise that we're seeing in the short term from America. I don't think that the noise that we're seeing is going to push trends back decades. So I think we've just got to stay firm to what we've seen as the growth areas, what we know to be the changes in society, and build assets and real estate which meet those needs.
Jonathan, you're also a passionate, Brit. I know you're at times frustrated about some of the taxes or the lack of, I guess, incentives for entrepreneurship in this country. Where are we at now?
Well, look, I've been very encouraged by the new government as a generality. I think, the Prime Minister has made great moves on the world stage, and he should be commended for that. And if you look at one act he's taken that I think he could be the bellwether for the future of the government, would be the removal of NHS England. Because it was a bold step. It was a big move to put a line through, Trumpian, some would say, in certain acts, in terms of just removing a layer of regulation. But what I think we need to see is we need to see that reflected within the business world. We need to understand that we're operating on a very, very big canvas. And really what we are competing for is the hunt for talent. We need to attract the best talent to this country. And I am concerned, as you referred to in your question, that some of the taxation policies that were started by the Conservatives in the last administration, but continued by Labour, are driving people out of this country. And I think that we need that talent, because when that talent migrates elsewhere, Britain ceases to be front of mind. And when you see Italy, for example, being a net beneficiary from the migration of talent from the UK, that is not a good thing. And we really need to address it in short order, because whilst we may have lost some people, A, we can attract them back, and B, we can ensure that we don't lose further. That, to me, is the single most important thing.
Jonathan, you've also been a co-owner of Chelsea Football Club for 3 years, and right from the start you said that you wanted a new stadium. It's taking a long time. Where are we?
Well, I mean, look, development in London is very complicated. It's a long-term game, and the shareholders have continued to analyse the options ahead of them. And we're hopeful that in the short term that a decision will be made that we'll be able to bring back to the supporter base and then bring back to the wider British public and show them the vision for the next 100 years of Chelsea Football Club.
Is there a danger that Chelsea is being allowed to drift and actually just won't have the same facilities that some of the other clubs?
No, I don't think so. I think that if you look at the training facilities, the way we're attracting players, I think if you look at the way that the women's team has developed, the women's team's in the semi-final of the Champions League, is leading the Women's Premier League by some distance. And we're very proud of the achievements. And the men's team's also had a very, very solid season. And with 7 games to go, is in a great position, to fulfil potential during the course of this year. So I don't think there's that worry. But I do think that we do need to ensure that there's a long-term vision which everybody can sign up to.
Should there have been a clear alignment with Clear Lake right from the start on the intentions for a stadium?
No, I think, look, if you look at the number of decisions that have been made between the two groups over the course of the last 3 years, almost 3 years, you can see significant alignment around a huge percentage of decisions. But there's a very big one out there. And, Todd and others have made it clear that we need to ensure that we get alignment for those decisions. And I'm sure that will happen.
Is it still fun being in football? I mean, this is part of the, the best of what the UK can give to the world. Being
involved in sport is great. We've recently got involved in the cricket world as well. We bought one of the franchises in the 100, which we bought a percentage of the Trent Rockets, which starts this summer. I think we see these as great growth opportunities, and we'll continue to dig in and hopefully expand the opportunities in those sports, both for the fans but also from an investment case.
Jonathan, thank you so much for joining us. That was Jonathan Goldstein, the Chief Executive of Kane International. Now, coming up, we'll speak to the Hungarian Foreign Minister, Peter Szijjártó, as a country argues against EU counter-tariffs on the U.S. That exclusive conversation is up next, and this is Bloomberg.
case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Markets bounce back. Investors remain on edge as the U.S. president sends mixed signals on the potential for tariff relief. China says it will fight the trade war to the end after Donald Trump threatens to raise its tariffs to more than 100%. And the EU proposes a 25% levy on a selection of U.S. goods, but American whiskey is spared. Well, shortly we'll be joined by the Hungarian foreign minister for an exclusive conversation. And Donald Trump's trade war is really reshaping the global order and roiling markets. Now, the new tariffs may provoke traditional partners to explore new alliances and develop deeper trade relations that exclude the U.S. Now, for more on all of this, let's bring in Ross Matheson, our EMEA news director. So, Ross, there's been so much turmoil and so much talk. Where do you think things stand right now?
Well, we're up against April 9, so we'll find out very soon whether Trump does make good on these reciprocal tariffs. So far overnight, he was sounding pretty resolute on that front. So then these things will take effect. And as you say, the key is how do countries react? And they're all reacting in slightly different ways. You know, China, for example, has come out pretty hard with retaliation, and that relationship is deteriorating pretty quickly. The EU, for example, is preparing and announcing what they will do, which is a bit of middle-of-the-road response, leaving room for negotiations. And other countries like Japan and Israel are moving quickly to try and have talks with mixed results for either side. I mean, the confusion here really is that Donald Trump is not just talking about tariffs. He's talking about non-tariff barriers being part of these conversations. And non-tariff barriers can mean essentially anything. And it's a bit unclear exactly what that does mean in Donald Trump's mind. And is it different things for different countries? So if you're a company or a country or a lobby group trying to work out how you liaise with the White House on this, it's very difficult to know your starting points. And so that's the difficulty that we're at in the very near term. Beyond that, as you say, this is rapidly reshaping relationships between the U.S. and long-held allies, between the U.S. and countries it's long had tensions with, but also countries with each other. I mean, the European countries are constantly talking to each other, working out what to do, but does it open the door to the EU having a different kind of relationship with China? Again, for example, do developing countries really band together further on this?
Ross, meanwhile, President Trump also says the U.S. is holding direct talks with Iran on its nuclear program, with the next round taking place on Saturday. Here he is.
We're having direct talks with Iran, and they've started. It'll go on Saturday. We have a very big meeting, and we'll see what can happen. And I think everybody agrees that doing a deal would be preferable to doing the obvious.
Ross, how significant is this?
Well, it's quite significant. The location is also symbolic, being Oman, where, of course, deals have been done before between the US and Iran. The fact it's just US and Iran is interesting. There's no sign of Europe in any of this, although, of course, the US is a key player in all of this. And the question about whether they're direct or indirect talks, we know there's going to be senior officials from Iran and the US, both in Oman. Are they sitting in the same room together, or are they passing notes through Oman officials as sort of intermediaries? But obviously the question is, what is the purpose of these talks? Is it to get some kind of conversation back towards a nuclear deal? We know that Donald Trump has been putting pressure on Iran and its proxies. Is it to show that talks would go nowhere? You know, he's been talking about beefing up the military presence in the region. Oh, is this just a chance to take a little bit of short-term pressure off the table? I don't think anyone's expecting a fulsome deal to come from this conversation, but at least the fact that they're going to be in proximity to each other does give that opportunity for at least a little bit of short-term lessening of tension.
Ross, thanks so much. Ross Matheson there, our EMEA News Director. Now, Hungary says it does not support the European Commission's plans for counter-tariffs against the U.S. Now, the country's foreign minister says retaliatory levies would lead to higher prices in the EU. Hungary has also been at odds with the EU on support for Ukraine, and it's planning to quit the International Criminal Court. Well, joining us now for a wide-ranging, exclusive conversation, we're joined by the Hungarian Foreign Minister. He's, of course, Péter Szijjártó. I'm excited to speak to you, Minister. We've been waiting for this interview for a bit of time. Now, you blame the EU for failing to negotiate exemptions with Donald Trump. How would you do it differently?
Good morning. Thank you so much for the invitation. It's an honor to be here with Bloomberg. So actually, since November, everyone knew that the U.S. citizens have elected a president who would carry out a very patriotic kind of political strategy, including economic strategy. Everybody knew President Trump had tariffs in his toolkit, so it was obvious that at some point of time this would come. And that's why we have encouraged the European Commission for a while to enter into negotiations with President Trump or with his team, his administration, about how to avoid a kind of trade war or a tariff war between the European Union and the US. And we had a concrete proposal, which we have put on the table of the Commission, which would have been the following. We all know that the backbone of both economies, US and the European economy, is the automotive industry. It is very sensitive what happens to the automotive industry because it has a huge impact on both continental economies. And we all knew that US used to implement and apply a 2.5% tariff on automotive imports from Europe, while European Union used to or has been applying a 10% tariff. On the same, so 2.5 against 10. So we have proposed to the European Commission to make a unilateral step to decrease the tariffs on automotive imports from US to European Union to 2.5%. We would have been on an even level, and I do believe that would have meant a good platform to start negotiations from. We should have tried that, and I really regret that we did not.
So, Minister, are you planning to talk to Trump on Europe's behalf? And I guess the question on the cars, although I don't want to spend too much time on this, is that we're just not importing enough US cars. So even if the trade bounds would still be there, even if you take away or get down some of the tariffs on them?
Well, I really do believe that even tariffs would have created a good platform for negotiations and would have shown goodwill. And this goodwill would have been able to lead to a different kind of situation compared to where we are now. Well, negotiating on behalf of the European Union, definitely we don't have the authorization for. It's the European Commission which should do it or should have done it. But I have to tell you that, regrettably enough, these kind of challenging times show very clearly that the institutions in Brussels are not able to lead. They are not able to come to solutions which would be beneficial for the European Union, for the European people. Unfortunately, this has been not the first crisis when this has been proved. That was the same with COVID, that was the same with migration, that has been the same with the war in Ukraine, that the European institutions simply are not able to lead and are not able to come to a right solution.
But, Minister, so are you open to bilateral negotiations with the US on these tariffs, or is it still the remit of the EU to handle this collectively? And how are you collaborating with them to try and mitigate some of the effects?
Well, you know that there are regulations in the European Union which make it very clearly that the policies on tariffs is a so-called community competence, so that comes with the European Commission. But we have been holding talks with the United States for a couple of months now about a special bilateral cooperation. You know, we are on very good terms with the Trump administration. We have been crossing fingers for President Trump to win the presidential elections, which he did, thanks God. So we are negotiating about a bilateral cooperation framework, which includes economic elements as well.
Minister, I mean, you know, to our surprise, he didn't give a better deal to Israel, who's some of his closest allies. So this looks like it's really hard numbers. Do you see these U.S. tariffs as part of a broader global trend of protectionism?
Well, I understand that, you know, President Trump has been carrying out a very patriotic kind of strategy, and economy is part of that. So he says America first. Everybody knew that he would apply such kind of measures as well. You know, the Israeli Prime Minister paid a visit to Hungary in the recent days. From Budapest, he flew directly to Washington, and I have talked to him a couple hours before he left Budapest, and he told me that he would have conversations with President Trump on that matter as well, which I understood he spoke about yesterday in the White House.
Yeah, you have a good relationship with the U.S., but at the same time, the U.S. partly blames corruption in the Hungarian public procurement in its official reasoning for the EU tariffs, right? So that's something that I think we need to remember. Does it make you disappointed in the U.S. in light of what, you know, President Trump has been saying?
Well, actually, thank you for raising this issue, because there have been fake news spread yesterday around this issue. So we are speaking about an annual report of the USTR, the U.S. Trade Representative. This report has been written last year because the deadline for the remarks expired in October, so well under the Biden administration, where we all know that the Biden administration looked at Hungary in a very hostile manner. We know that this report is being put together based on the substantial information provided by the U.S. embassies. It is written in the report. And you know that the former U.S. ambassador under the Biden administration used to be a person who was very hostile to us. He was basically a political activist in Budapest. He was leading the Hungarian opposition, actually, commented domestic issues on a daily basis, criticizing the government 24/7. So actually, we see his sentences there. So we are pretty sure that the next report, which is going to be written by this administration already, will be totally different.
Minister, I also want to ask you about Chinese investments, because you welcome China, also their soft power influence. Is that a point of tension with the Trump administration?
Look, I have to tell you that I have been in this position for almost 11 years now. So I've been dealing with China and economic cooperation with China for 11 years. China is now a top investor in Hungary. 17 billion euros of investments, mostly in the automotive industry, are going on in Hungary by Chinese companies. 2020, 23, 24, in these 3 years, Chinese investors invested the most in Hungary. But I can tell you one thing for sure. Never ever they have confused any political issue with the investments. They have never put together any kind of political expectation to these investments.
So you don't have to choose?
No, actually not, because, you know, our strategy is very clear. This is the economic neutrality, which means that we are open for investments from the East and from the West as well. So if you look at the top 3 investors in Hungary, is Germany, China, and the United States. 1 European, 1 American, and 1 Asian. So we are very, let's say, very balanced in this regard. And one more sentence, if you allow me, when it comes to Chinese investments. You know, we are now becoming number 2 in the world when it comes to the production of electric batteries because of the Chinese investments. But why the Chinese investments have picked Hungary in Europe, why 44% of all Chinese investments heading Europe came to Hungary, is because of the Germans. And I tell you why, because besides Germany, we are the only country in Europe to be hosting all 3 German premium car makers. And they are all working together with Chinese suppliers. So if you look at Hungary, you see big German factories and big Chinese factories built next to each other.
Minister, I have many questions also on Russia.
Please.
I think you visited Russia at least 13 times since the start of the full-scale invasion of Ukraine, more than any other EU foreign minister. What is the purpose of such visits?
Well, I wish others had done the same, because I do understand that the only way out of this war comes through negotiations. And we are very thankful to President Trump that the current administration has started these negotiations finally, because this war does not have any kind of solution on the battlefield. That has been proved already. So if you don't have a solution on the battlefield, you must have a solution around the negotiating table. And thanks to President Trump, these negotiations have been going on. We have a very important cooperation with Russia when it comes to energy.
Yeah.
Why? Not because of political reasons, but because of physics and infrastructure. So we cannot cut ourselves from Russian energy sources because, physically speaking, we would not be able to supply the country. We are a landlocked one. So we depend on our neighbors, and since our neighbors have not made their, infrastructural investments and projects, we are mostly dependent on sources from Russia. Russia has been a reliable partner so far when it comes to energy deliveries. No one gave us a better offer so far. No one gave us a more reliable and cheaper offer than offered by Russia. So obviously we are in connection with them. We are in a fair cooperation with them when it comes to energy, and we cannot give it up under the current circumstances.
And Minister, we don't really know exactly what happens next, but would you support the next renewal of EU sanctions on Russia when it comes due next year?
Well, first
Actually,
of all,
at the end of this year.
Yeah, well, generally speaking, I think that the policy of European Union based on sanctions has failed. Why? Because these sanctions have hit European economy more than the Russian economy. This is number one. Number two, of course, our decision will depend a lot about the, let's say, geopolitical circumstances. We see how successful U.S. and President Trump personally will be until the next decision, and we will, make our decision judging the actual circumstances at that time.
Minister, do you believe Russia really wants peace?
Well, I do hope that both parties at war want peace, but what I really know is that President Trump and his team is committed to make peace, and I think this is really great news. Secretary Rubio made it very clear at the end of last week during the NATO Foreign Ministerial that they don't give up their commitment. They are committed to make peace. They are committed to negotiate with both parties, and I think that the world has become a safer place in the last couple weeks just because of these negotiations. Because although we don't know whether peace is going to be made on a short term or medium range or long term, but what we know is that the risk of escalation of the war by the fact that the Russians and the Americans are in direct negotiations has been decreased. And this is good news for us, a country which has been in the neighborhood for 3 years of a war.
Minister, could you explain, I mean, Budapest has also tried to leave some sanctions on certain Russian individuals, for example, the sister of Usmanov.
Yeah.
What's the reason behind that?
Well, simply rationality and simply legal approach. So I think that these sanctions have been challenging the seriousness of the European Union as well. So if you put persons on a sanction list without any kind of real reasoning just because, then it ruins your seriousness. So we wanted to save the seriousness. So no, I think those are legally not based decisions, and those decisions which are legally not based, we usually don't support.
Minister, maybe a final question
Yes.
on the rule of law and the International Court of Justice. You've often clashed, such as migration and judicial reforms. With Hungary now, withdrawing from the ICC, does that deepen the divide with Europe?
Well, you know that we have been in office for 15 years now, and we are a very characteristically right-wing government, Christian Democrat, patriotic political strategy, sovereignist. And this is not something that would be digestible by the European Commission. So for the last 15 years, there are always political debates, because when it comes to big issues like the illegal migration or LGBT issues or the war itself, our approach is totally different than the approach of Brussels. So that's why we are under continuous attacks. But these attacks are being shown as if they were around the rule of law, which has nothing to do with the rule of law. Yeah. This is politics. This is politics. When it comes to
ICC,
yeah, on ICC it was on ICC there was a very concrete issue that actually ICC became a political institution or a political body, and a court cannot become a political body. And the fact that they issued a warrant on the Prime Minister of the State of Israel, that was a very clearly politically motivated step. And we don't want to be part of a so-called court which bases its operation on political basis. This is no-go for us. That's why we decided to leave.
But are you firmly committed to staying in the Union?
Of course. You mean European Union?
Yes.
No question, obviously.
There's no question. Like, there's not a point where you say actually.
No. Of course, we look at ourselves as being members of the European Union in the future as well. Although we would like to reach some reforms in the European Union, because currently the competitiveness of European Union, the strength of European Union is very low. So we would like to improve the strength and the competitiveness of the European Union. There's a big debate, because many think that European Union should be a super superstate, a federalistic superstate directed by and from Brussels. We see it differently. We think that the European Union should be an integration of strong countries, of strong member states, which are sticking to their history, their specificities, you know, and so on, and so on, religion, and so on, and so on. And this is a big clash. So we see European Union in the future as a strong union based on strong member states. And here we differ when it comes to, you know, the concept with Brussels.
Minister, thank you so much for joining us. The Hungarian Foreign Minister Peter Szijjártó. Now, coming up, we'll be joined by Maya Bandari from Neuberger Berman to dig into the fallout from Donald Trump's tariffs. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Now, Citadel founder Ken Griffin is the latest Wall Street titan to criticize President Trump's tariffs, calling them a huge policy mistake. Well, joining us now, Maya Bandari, Chief Investment Officer for EMEA Multi-Asset Strategist at Neuberger Berman, and Alan Wong, Bloomberg's China Economy and Government Editor. Alan, let's just kick off with you, because there's been a huge pushback, actually, from China. I mean, they feel like, you know, that they're the ones with the blueprint on how to fight back. Does this escalate, or does the U.S. actually get scared and back down with some of the China initiatives?
Yeah, China certainly is trying to project a very brave face after Trump threatened to increase 50% tariffs on Chinese imports. China earlier today, said that it will hit back until the end, and that Trump's threat is a mistake on top of a mistake. So China hasn't said what it will do in response to Trump's tariffs if they do come through. But we've heard some suggestions from some influential commentators in China suggesting that China will hit back and will resort to more targeted measures to hit Trump where it hurts.
So what can China possibly do if Trump actually follows through, Alan, something that would be significant and people would take notice of?
Yeah, so these are not verified or official announcements, but these two bloggers made a big splash on the Chinese internet, which is now trending, suggesting that China could put more tariffs on the imports of U.S. farm products such as soybeans and sorghum. And other than that, they suggested that China could hit the U.S. services sector, which actually runs a trade surplus with China. And in addition to that, they also suggested that China could ban the screenings of Hollywood movies in China, which, as you know, China controls what movies can be imported into the country and what cannot.
Oh.
So those measures, once again, they're unverified, but has been floated and is being circulated widely on the Chinese internet.
Alan, thank you so much. Maya, I mean, first of all, congratulations on the new job. I've been missing you on TV, but you started right when the world seems to be falling apart. Like, how do you do this tariffs, and what does it mean for just investment overall?
Well, I think there are maybe 2 or 3 things to say on the tariffs. I mean, I think first that what was announced last Wednesday, I think, was pretty close to the worst case that we at Neuberger Berman and I think others were expecting. And look, Francine, they're hugely disruptive and do represent a shift in the world, in the world order. We've gone from 2.5% at the start of the year to 7% a week ago to somewhere between 20 and 26% right now. And partly for that reason, we don't expect the tariffs that have been announced to actually be what's ultimately implemented. So I think that's the first thing to say. And amidst all of this, there's clearly been an uncertainty shock, if you will, to the U.S. economy. And we have, at Neuberger Berman, downgraded our growth expectations. So we expect sub 1% growth, 0.5 to 1%. And inflation is higher. So we're now expecting 3.5% inflation. And I'd say, broadly, the risks are to the upside to inflation and the downside to growth.
So for the Fed, what does that mean, Maya? I mean, I guess everything depends on the Fed and how many times they cut and whether we see an emergency meeting which could sow more panic on the markets.
Look, I think, Francine, the Fed is ultimately led by financial conditions and how financial conditions behave. Now, I think until really yesterday, you would have said, well, financial conditions have tightened, but bond markets remain pretty orderly. Yesterday was a bit of a shift in that. And, if we cast our minds back to the final quarter of 2018, just before the infamous pivot, we had a similar situation in that we had, bond yields rising in October, then real yields in November, and credit spreads in December. Until yesterday, all we'd really seen was credit spreads widening. I think if this bond market route has legs, if you will, then that strengthens the case for the Fed to respond. But it's got weaker growth and stickier inflation, so it's not an easy spot. And we're not in the camp, at least at the moment, of 5 cuts this year. We'd be erring towards less cuts.
So is volatility a given, or are we going to see more of a correction?
I'd say, volatility, I think, is something we expect to stay. Now, we've clearly had huge moves in markets. I mean, last week's moves in U.S. equities were like a 10 standard deviation event. But look, we're not turning positive on U.S. equities just yet because there's still a lot we don't know. We don't know how other countries are going to respond. We don't know how companies are going to take all of this on. And earnings season is going to be really important in all of that. So, I mean, things that we've done in portfolios at Neuberger, we've nibbled into gold. That's an asset we like. Last week.
Question mark.
Treasuries. We've had a long bias towards bonds, but we've clipped that back as well, and are looking at some of the areas that have been collateral damage in a way. JGBs, for example. Some of the banks in Europe and Japan look quite interesting, but we haven't actually pulled the trigger just yet.
Maya, I was going to ask you, there's a bit of a turnaround, a tiny turnaround in the markets today. Yeah. Is that dip buying, or is it wait and see?
I mean, I think it's just sort of short-term moves. I mean, I think what we saw yesterday just reflected how eager markets are for some positive resolution. I mean, that 15-minute rally we saw on hope for resolution was quite something. And so, yes, I think there are positive hopes. We think that ultimately we will have a negotiated outcome, but there still is, I would say, a fat left tail. It's no longer fattening at the same pace as last week, but it's still fat.
Maya, thank you so much. Great to have you back on TV. Maya Bandari there from Neuberger Berman and Alan Wong previously on talking about China. Up next, Bloomberg Brief, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
First time
got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. A rally gets underway after a manic Monday bookends a $10 trillion stock wipeout in just 3 days. Negotiating get permanent. Washington's clashing comments on tariffs keep investors on edge. And fight to the end. Beijing vows retaliation. President Trump threatens to slap another 50% levy on China. So is this it? Is this the turnaround Tuesday, or is it the dead cat bounce? A healthy rally underway. Russell 2000 futures up nearly 2%. S&P more than 1.5%. A wild day of a swing yesterday. A fake headline on a 90-day tariff pause at one point, causing stocks to surge 5%. It shows you just how badly this market wants to rally. Speaking of a rally, look at what can happen when you do get reassuring words out of the White House. The Nikkei rallying 6%. Treasury Secretary Scott Bessent saying, I would expect that Japan is going to get priority. So can negotiations happen? Maybe not if you're China. The focus of Trump's ire continues to be on that. Sovereign bonds, potentially the most interesting asset class. Heavy selling yesterday. We turn to a mixed picture this morning. A rally for the longer end because it was the longer end that took the brunt of the beating. The biggest spike for 30-year yields since March 2020. Biggest spike for 10-year yields since the Liz Truss global meltdown. We have a slight rally underway, and we're back above 4%, though, for your U.S. 10-year yield. So that's the overall market picture. Stocks, though, moving underneath the surface. Let's get some of your stocks to watch. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So I'm watching Broadcom in the pre-market today, gaining around 4% as the company says it's going to buy back around $10 billion worth of stock and reiterates the confidence in its key markets, including AI and also cloud software, providing some relief for a sector that's really been part of this big downturn in recent sessions. Then we've also got a bit of transatlantic M&A for you in Infineon in Germany, buying the automotive software division of Marvell Technologies, and we can see a decent move in that stock as well. Bear in mind, priced at 35 times earnings, much more expensive than it was predicted. Finally, Levi's reiterating its guidance in the apparel space last night after the close, predicting an acceleration in its organic growth, though analysts reckon those blue jeans are going to get more expensive due to tariffs. Finally, just to reiterate, the shout out for our pre-market wrap available on the terminal before the opening bell. Check that one out before the market open in New York.
Joe, excellent work as always. Bloomberg's Joe Easton. And in just a few minutes, we're going to be speaking with Seema Shah of Principal Asset Management. Later this hour, we'll also be catching up with Nancy Tangler of Laffer Tangler Investments. Now, as I mentioned, the bond market has had some interesting moves. Yesterday, it was 21 basis points higher for the 30-year yield. That makes the biggest spike for the Treasury benchmark since March of 2020, despite the fact that risk assets continue to be under pressure. Principal Seema Shah writes this: growth concerns are likely to dominate sovereign bond dynamics, pushing yields lower as labor markets cracks start to show more clearly. However, expected tariff-driven inflationary pressures imply that the bond market rally may be somewhat capped. I'm pleased to say that Seema joins us now. She's global strategist at Principal Asset Management. Seema, wonderful to see you this morning. It's been a wild ride. Yields dipped at one point below 3.9%. 10-year yields now back above 4.1%. Is there an element, because of what you outlined, because of deficit concerns, if we are going to a recessionary need to spend, that maybe treasuries are less attractive as a haven this time around?
Hi, Danny. I think there is an element of that. There's a lot of discussion in the marketplace exactly why yields rose yesterday. And one of the things that we're seeing is that because of concerns around recession, there are fears that, tax revenue is going to be somewhat lower, and that's going to be, of course, a negative impact on the deficit. And you couple that with concerns as well. I don't think anything's verified yet, but concerns that there could be growing, distrust of the U.S. Leading to additional upward pressure on the long end of the bond yield. So these are things that we do need to watch. Now, at the same time, I think the key things to consider is, look, if there are growth concerns, and provided that the Fed is cutting rates, there should be downward pressure on yields. It's just that it's not going to be as significant as maybe would have seen in previous downturns.
Seema, if we do continue to see this, though, maybe just a move slightly higher in yields, the dollar under pressure, stocks under pressure, is there an element, and you're kind of hinting at this, but I think it's a question that we're increasingly asking in these days, is it peak U.S. dollar asset ownership? Is there a sense that there's maybe a loss of confidence in the U.S.?
Well, I think it is really early days, but you're right that this is a conversation that people are already having. It actually started at the beginning of the year with conversations around U.S. exceptionalism. Now, I don't think anyone saw that it would spiral to this point, but it is a discussion. Now, I think the counter-argument to that, though, is to remember that, even if you're not interested in the dollar, there has to be an alternative currency, something else that investors are willing to put their focus on. At the moment, and certainly for the last couple of years, we haven't really had an alternative. So much depends on what's going to happen with Europe. Are they able to really strengthen their economies? What's going to happen with China? Does it start to also be seen as a reliable trade partner, investing partner as well? So there are still a lot of question marks, but this is clearly a conversation which is gaining a lot of momentum for investors right now.
And the other question that seems to be plaguing investors is, what does the Fed do? And I guess, how important are they even in this? But on that point, Seema, Austin Goolsbee spoke yesterday. I just want to take a quick listen to what he had to say.
The anxiety is, if these tariffs are as big as what are threatened on the U.S. side, and if there's massive retaliation, and then if there's counter retaliation again, it might send us back to the kind of conditions that we saw in 21 and 22 when inflation's raging out of control.
Seema, there we have what last year I think we can describe as the most dovish FOMC member talking about inflation like it's 2021 and 2022. What does that tell you about the Fed's willingness to step into this market and deliver it cuts?
Yeah, and I think those are really concerning words that we heard from Goolsbee there. Certainly when we're looking at market expectations, I think for 4 to 5 rate cuts this year, we're not quite there. We think that the Fed is going to be somewhat constrained because of these concerns around inflation. They need to see, first of all, they need to see policy clarity, exactly what is happening with tariffs. We know that, of course, we've had the announcement, but we don't exactly know how retaliation is going to work out. So I think the Fed is still waiting to see that. They also need to see how the hard data actually responds. We've only seen the weakness in the soft data. We are expecting it to play through in the hard data, but I think the Fed really needs to see clear evidence of that. And then the final thing, of course, and the most important, is what happens to inflation. and what happens to inflation expectations. From our forecast, we are expecting inflation to rise up to around 4%, if not slightly higher. And from our perspective, that means that the Fed is not able to come in with considerable aggression in providing the policy easing that maybe the economic side of the equation really, really requires. So it is concern, but again, so much is still to play for. There is a lot of uncertainty out there of how these negotiations are going to play out. And we could, as we saw yesterday, we could see some kind of headline which triggers a significant move in sentiment to the upside, and then we're in a very, very different place. So I think from the Fed's perspective, it is still a wait-and-see situation.
Can we talk about that for a moment? Just this insanity, it felt like in markets, where you got a fake headline about a 90-day pause written in the Bloomberg style on someone's Twitter account, and you see U.S. stocks surge and add $2 trillion and then wipe it out as soon as the White House responds saying that it's not the case. This is a market that is hanging on the words of one man, and that is President Donald Trump. Just how fragile is the market in this moment?
Well, as you said, I mean, I was there yesterday. We were all trying to desperately try and find clear evidence of that statement that was put out there. So I think there's two things it tells us is that the market is eager to have some kind of buying spree, right? So at the moment, for us, in terms of positioning perspective, for example, we're not willing to move quite to an underweight position on risk assets because we know that there is a potential upside at any moment. But as you said, this is almost moving away from economics. We know what the economic picture could be, but the economic picture completely relies on exactly what the administration is going to do, and specifically what President Trump is likely to announce at any point in the next day, week, month.
Yeah, I mean, it feels kind of impossible in this moment, Seema, to do any kind of macro analysis or even any corporate analysis when we just don't know yet the full picture. And if it is bringing trade deficits to zero, it is a slow-moving ship. Seema, so wonderful to have you on This Morning and Every Morning. Seema Shah of Principal Asset Management. Let's get you some other stories now that are trending on the terminal. Billionaire Ken Griffin calling President Trump's tariff policy a, quote, huge policy mistake. The Citadel founder urged people to reach out to Trump and to encourage the president to take a step back. Griffin is part of a growing roster of prominent finance executives who supported Trump and have also spoken out about the risks of tariff policy since it was announced last week. Warren Buffett is among the rare few whose personal fortunes have grown this year in the chaos of the market. His net worth has climbed $11.5 billion this year to $153.5 billion. That according to the Bloomberg Billionaire Index. The world's 500 richest people have lost more than $500 billion in just the last two trading sessions that followed Trump's announcement on tariffs. Chinese auto giant BYD flagged that first quarter profit may more than double after a bumper start to the year that saw vehicle sales top 1 million. The company said total sales up to March are 60% higher than a year ago, and its overseas expansion achieved leapfrog growth in the quarter. Coming up, the U.S. threatens to retaliate against China's retaliatory tariffs. China vows to fight to the end. We'll break it down next on your Bloomberg Brief.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals, and in certain cases they're going to be paying substantial tariffs.
President Trump ruling out a pause on tariffs there. The administration, though, did have different messages on the scope of potential tariff negotiations. The president says that some tariffs can be negotiated while others are permanent. Treasury Secretary Scott Bessent telling Fox that everything is on the table. But meanwhile, White House senior counsel Peter Navarro writing in the FT that this is not a negotiation. We bring in team coverage of tariffs this morning. Brendan Murray leads our global trade coverage, European correspondent Oliver Crook in Brussels, and China economy and government editor Alan Wong. Brendan, let's start with you. Different messages coming in from the White House. How do we make sense of it?
Yeah, we definitely heard a range of things from the White House yesterday, for everything from the threat of another 50% tariff on China to talks that will begin with Japan. Japan didn't threaten to retaliate in the weeks leading up to this, so the reward, it seems, for the Asia's #2 economy is to sit down at the negotiating table. Now that was one of the rarer spots in line to have discussions with the administration. China, the relationship seems to be going in the opposite direction. Trump posted on social media that all talks are suspended with China. So there's a real a game being played here as to if the administration saying, look, if you play ball with us, you just take the tariffs and we'll negotiate from there. Then you can have a seat at the table. If you retaliate against us like China has threatened, there's a game of chicken being played here to see who will blink first. And China is saying it will fight to the end. So here we have the world's two largest economies in a showdown over tariffs.
Brendan, but even that is a change in tone, because let's remember where we came from. Before this, we had Trump saying that these were permanent. The administration was really talking about this idea that they wanted to get trade deficits down to zero. The fact that they are talking about negotiations, not when it comes to China, but with other countries, have they given themselves an off-ramp after so many criticisms from those who support the Trump administration, business leaders, and the destruction in the stock market? Are we starting to see, despite Trump's denial, something of a policy put?
Not that we can tell. I mean, look, these tariffs are going to take effect in the next 24 hours, and that's where the negotiations start. Look at the example of Israel. Israel came to the White House yesterday. It walked away with no relief from the tariffs that Trump is putting on, the reciprocal tariffs that Trump is putting on Israel. So that is not a good sign if you are a U.S. ally who's looking for a break. This was something that was unexpected, and Israel walked away with nothing in return.
Yeah, again, I mean, you see from Scott Bessent there making the comment that he's optimistic about striking deals with other countries, but everything does impinge on one person's word, and that is the president. Alan, on that point, I want to get to you and bring you into the conversation, because we did have this threat from Trump of an additional 50% tariff on China. What's been the reaction in the region?
So China has responded with very tough rhetoric, saying that China will fight till the end. In fact, China called Trump's action to escalate those tariffs a mistake on top of a mistake. It left the door open to negotiation, but China has signaled that it will definitely dig in and not come to the negotiation table just because Trump is piling on pressure. Domestically, it also moved to shield the economy from some of the impacts of the tariffs, so just to show that it is ready to take this battle.
Alan, I also thought it was really interesting, the story we have about Shein, that China has urging them to halt any supply changes that they might make in order to help get around some of the tariffs. For companies that are looking to get out of China, especially Chinese-based ones, how much resistance are they going to face?
Yeah, so China doesn't want factories to move out of China, and as we have seen since the first Trump trade war. So Shein now is, we've reported that, has gotten a memo from Chinese authorities that they don't want them to move production overseas. In fact, they canceled some reconnaissance tour in Southeast Asia, in Vietnam, after the authorities made that position clear. So it's a tough situation for those companies like Shein, because at the end of the day, they want to make more profit and they want to avoid the tariffs. But China worries about the implications of relocation to the job market, and also if Shein does it and other companies follow suit, what is left of Chinese manufacturing?
Oliver, let me bring in you, because you've been in Brussels, you've been speaking with leaders there, you've been getting the real-time reactions coming out of the White House. Trump has said no deal so far with Europe. What has been the reaction?
So what's very interesting in speaking to the number of trade ministers yesterday who were assembled in Luxembourg to basically try to assemble a coherent and cogent response to the Trump administration is that they're basically operating under Plan A and Plan B. Plan A is the plan that they would like to see, that is a negotiated outcome. But when you talk to these trade ministers and you ask them, do you have any idea what the Trump administration actually wants? Do you know what they mean by non-monetary barriers? Do you have a clear idea of what they're asking for? They really don't have a very good answer for that. When you ask them also, do you have any indication that the Trump administration actually wants to talk? The answer is, again, no. So that takes us to Plan B. And Plan B is a sort of more full-forced retaliation by the Europeans that will include not only tariffs on goods, but also tariffs potentially and taxes on services. We're talking about U.S. tech companies as well, potential regulation there. This is the list that they're also assembling. The other thing we heard from all of them was that while they want to de-escalate the situation, they want a negotiated outcome. That is very, very clear. All options are on the table. Having said that, there's not been a huge amount of communication between the two teams, between the EU and the U.S. administration. We heard from the sort of trade emissary from the EU, Sefcovic, saying that basically we're not going to wait forever. What they're trying to do is build out as much runway as possible to have a negotiated outcome. Remember, they're going to impose some retaliatory tariffs next week. That is in retaliation to aluminum and steel. That is not in retaliation to the 20% we're expecting tomorrow. They're trying to build as much runway to have a negotiated solution, but the probabilities of that, Danny, at this point, I can't say seem to be very high.
Yeah, I mean, look, it has been China and the EU that seems to be the target of Trump's ire in this. Brendan, Oliver, Alan, thank you all so much for joining us. Brendan Murray, Oliver Crook, and Alan Wong with our Bloomberg team coverage. Coming up, after weeks of tension, Iran and the U.S. head to the negotiating table over the nuclear program. We're going to take a look at some of the top headlines this morning on your Bloomberg Brief.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what the newspapers have on their front page this morning and what's making headlines. First up, the Washington Post has this, that President Trump said that Iran and the U.S. have begun direct talks over Tehran's nuclear program. The Iranian foreign minister confirmed the talks, but said that they would be indirect. Trump spoke about the upcoming negotiations.
We're having direct talks with Iran, and they've started. It'll go on Saturday. We have a very big meeting, and we'll see what can happen. And I think everybody agrees that doing a deal would be preferable to doing the obvious.
Next up on the Bloomberg, House Freedom Caucus Chairman Andy Harris says that he's open to the creation of a new 40% tax bracket for those earning $1 million or more. It comes after decades of Republicans opposing any form of tax increase. The GOP under Trump has grown more populist, allowing some lawmakers to back away from the party's long-held stance, along with concerns about a growing deficit. And the New York Times leads with the Supreme Court letting the Venezuelan deportations continue for now. They overturned a lower court order that had put a temporary stop to the deportations. It is a victory for the Trump administration, although it did not address the constitutionality of sending migrants to a prison in El Salvador. A quick check on markets as we head to the break. It continues to be a rally for U.S. stocks, up more than 1% in the pre-market session, 1.4%. With talk of negotiation with Japan and others, this market is treating it as, yes, this is a negotiation tactic from Trump. Is that really the case? We've heard from Peter Navarro writing in the FT saying that this is permanent and that this is not negotiations. Coming up, have we hit capitulation? We're going to discuss with Nancy Tangler of Laffer Tangler Investments, a conversation you do not want to miss. Stay with us. DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Bouncing back, stock futures rebound after a manic Monday bookends a $10 trillion stock wipeout in just 3 sessions. Deal or no deal, clashing comments on tariffs out of Washington keep investors on edge. And fight to the end, Beijing vows retaliation as President Trump threatens to slap an additional 50% levy on China. So is this it? Is it the turnaround Tuesday? Or is it the dead cat bounce? A 1.4% rally in your S&P 500 future sessions. We're still down some 11% since Liberation Day. By the way, Goldman Sachs warning of a bear market. BlackRock has downgraded U.S. stocks, so the sell side's still catching up with some of the losses. But here's what happens when you get the promise of a negotiation. Just look at how Japanese equities ended the session, up 6%. Bessent saying that I would expect Japan is going to get priority. So maybe there are negotiations to be had. Maybe there is an off-ramp with the White House just concentrating on China to get the ire, to get an additional 50% tariffs. Maybe the weird thing of yesterday's session was the bond market with this huge spike in 30-year yields, the most since March 2020. For 10 years, it was the biggest spike since the Liz Truss global meltdown. We rallied this morning, though, down about 1 basis point across the curve. Well, Nancy Tangler of Laffer Tangler Investment is weighing in on the policy uncertainty that's been keeping investors on edge, writing, quote, have we hit capitulation? Depends on what the Trump administration proxies tell us. Beyond, we have received phone calls from 50 countries. After that convoluted rollout, the market needs some clarity, like what kind of deals have been struck. Joining us now is Nancy Tangler, CEO and CIO at Laffer Tangler Investments. Nancy, thanks so much for joining us.
Oh my gosh, so good
it's
to be
such a
here.
pleasure to see you. That makes complete sense, but how do you even do that in this moment? When you are hearing conflicting messages coming out of the White House, it's permanent, we're in negotiation, this isn't a negotiation.
You know, it's funny, I get the art of the deal, and I just don't think it plays very well in broad daylight. And that's really what we had. That rollout was more like amateur hour than The Apprentice, you know? And I think then the proxies that have been out there, Howard Lutnick saying one thing, saying we don't have a plan for the dollar. What does that mean? And so I think the market got super skittish, as you would expect it to. Yesterday was interesting because we saw some calm. You know, we were open down, 1,500 points on the Dow, and then we ended down, you know, after many gyrations, we ended down about 350. And I think that was a sign to me that the market's starting to pay attention to, you know, Scott Bessent meeting with Japan and, you know, some calm around the chaos.
It feels like such a sign of the times, Nancy, that we can swing $4 trillion and that's a calm day in this equity market. On that, though, look, I know there was this fake headline about a 90-day pause and we're off to the races, but is there almost signal to be had in that? The fact that equity markets saw that and believed it and were so willing to rally to such a huge extent.
Yeah, I thought that was really interesting because what does a 90-day pause do but extend the pain? So, but yes, I think that's absolutely true. And we may not be out of it yet. You know, we get a little rally today. We may have more selling. But I do think, I mean, we know one thing. We were due for a correction. We get one every 12 months on average, about 10%. So we knew that had to be in the offing. But it was just the ridiculousness of it all. When, you know, the futures were kind of flat. And then when he held up the chart, and, you know, we were all looking at it going, what? Those aren't the tariffs. You know, this interpolation of the trade deficit. You know, I grew up at the knees of Dr. Laffer. I'm partners with his son, Arthur Laffer Jr. And trade deficits are not necessarily bad. It depends on why you have one. And we have one because we're prosperous and we're a nation of consumers. And so this notion that all trade deficits are bad and therefore they're going to have to make it right, that our trading partners, it makes no sense to the average person.
Well, it's interesting because I feel like you're describing two things. One is just the economic fundamentals and what might happen if we try to attempt that. The other you're describing is a loss of confidence in U.S. policy, it sounds like.
Yeah.
Which is more damaging at this moment?
The loss in confidence, for sure. I think, you know, I think it's not prudent to go to war with everybody at once. I'm sure that's a quote from Xing Su or one of the famous. But you want to pick them off one at a time. And so it appears now that the focus, as you mentioned earlier, is shifting to China. That would probably be okay with the markets. It's going to hurt some companies. We've seen Apple and Starbucks just get annihilated. They've melted down. But, you know, the other thing is to remember is that Americans want to buy cheap iPhones. They don't really care where they're made. So we have to kind of come to grips with that. And, you know, if this continues, the $500 billion that Apple, you know, pledged to invest in the U.S. could be at risk. And the last thing I'll say about this, Danny, is that, you know, we've been told it's for the manufacturer employment and the employing of U.S. people, Americans, however you want to say that. But, you know, we immediately saw layoffs at the auto companies. And if you look at manufacturing GDP, 68% is imported parts. So we have to, that doesn't get fixed overnight. So I think, you know, I heard yesterday that there's talk of a tax credit, an export tax credit for manufacturers. So if we're collecting over here and paying out over here, I really don't get what the point is.
Well, it's a really slow ship to turn around. 100%. If you want to do something like this, arguably longer than a 4-year presidential term. So what do you think will be the willingness of companies to actually change their supply chains, to invest in manufacturing? Again, if it's a project that takes longer than 4 years, then Trump will be president.
Yeah, or 2 years when he's no longer, you know, before he becomes a lame duck. Because if this continues, I think then the House and the Senate are really up for grabs. So that would not be good for him. So that's why I think we'll get some resolution. But you're right. I mean, they already did adjust supply chains after COVID. And then we have the USMCA that was negotiated by President Trump. So these parts moving back and forth across country lines or borders, it was part of the USMCA. So I think that's where people are going, they're scratching their heads and saying, which is it? And you're bringing up the right, why are we doing this? Is it retaliation? Is it to improve jobs in the U.S.? I don't know. I think the message has been very muddy.
I gotta say, Nancy, it almost feels ridiculous to talk about markets and what to do in this environment when we're talking about these huge economic theory questions that we're watching play out, when we're talking about so much uncertainty. So what do you do at this moment in markets? Is it a time to sit on the sidelines? Do you buy the dip? Because these are big questions that we're trying to grapple with right now.
No, it's hard. And, you know, I have a track record. So, I mean, I manage money. I'm not a strategist that says, oh, I just lowered my year-end forecast, which is not a criticism. They have a different job, but I can't do that. So what we've been doing is we sat on the sidelines initially, and then on Friday, we put some money to work, and we added to names that we think will be beneficiaries of ultimately some tariff, but not the kind of confusion we're getting right now. So we added to Microsoft, we added to Accenture, we added to TJ Maxx, even though, you know, the consumer might be at risk. We think consumers are working, it's a higher end consumer, they'll be able to continue to spend. The import question is unresolved, but because they buy from 100 countries. But and we added to Netflix, so names that, you know, we own Spotify, it was one of our 5 for 25, names that would probably continue to do well if we do go into a recession. But we're not walking away from the AI trade. We still think that will drive productivity. We've, you know, 5 consecutive quarters of 2% productivity growth. So I think we've just shifted to software, and we did that starting about 7 months ago.
So NVIDIA, you know I have to ask you about
We
NVIDIA.
do, we own it, and we added to it.
Adding to it?
Yeah, we did a couple weeks ago. So we didn't bottom ticket, but I'm going to be happy with the purchase price a year or two from now. I mean, it's trading at a ridiculously low multiple and price earnings to growth PEG ratio. So we added to that. We even added a little bit to Tesla. And some of the software names like Palantir and CrowdStrike, which, you know, in our growth strategy, those are names that we've also added to. I think investors, this will settle down at some point, and I think you still want to be long the AI trade.
All right, Nancy, next time we get you in, we're getting Dan Ives here too. I think we need a conversation with the two of you.
We need a fashion off.
Yes.
Yeah.
Well, we know you're the more fashionable Nancy. I think that's obvious to anyone. Nancy, thank you so much for joining. It's always seriously such a joy to have you on. Nancy Tengler there of Laffer Tengler Investments. You are watching Bloomberg Brief.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah. We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many, many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs.
President Trump ruling out a pause on tariffs after a report, a fake one, sent the stock market soaring briefly on Monday. The president and two of his closest advisors each seem, though, to have somewhat different and nuanced views on how negotiations will go. Treasury Secretary Scott Bessent told Fox everything is on the table. White House senior counsel Peter Navarro wrote in an op-ed in the FT, this is not a negotiation. Meanwhile, President Trump says that some tariffs can be permanent and some can be negotiated. Joining us now is Bloomberg's Michael Shepard on this. Shep, really great to see you this morning. And look, there is a change in tone. As confusing as it might be, we hear the White House talking about negotiations, about meeting with Japan. Scott Bessent talking about 50 countries calling in and saying everybody's negotiating except China. Are they giving themselves a sort of off-ramp here?
Well, I think they're eager to have some sort of off-ramp, especially in the wake of the market meltdown that we have been witnessing unfold since the announcement on Wednesday. Investors and companies around the world did not digest the results of the tariffs that were unveiled last week favorably at all. And they see the risk to inflation, the risk to economic growth. And now the president and his team are trying to figure out what is the way out. Now, for Donald Trump, it's difficult for him to immediately signal any sort of idea of relenting on this big plan that he unveiled with so much fanfare. But at the same time, his advisors are trying to lay the groundwork for those talks. And Japan, significantly one of the world's largest economies, is a great way to start. Trump has traditionally had stronger relations with Japan. The former Prime Minister Shinzo Abe was particularly close to the president, and he's hoping to forge a similar bond with the current Prime Minister Ishiba, and perhaps find a way to get more favorable treatment of agricultural goods and automobiles. Those are two areas where the president has identified as ones he would like to see some progress made on. And because Japan had come forward early with an idea of actually having talks, Bessent said Japan will be among the first in line to have that kind of a deal. It's less so with the European Union. Trump kind of turned aside this idea from the bloc to drop tariffs to zero on industrial goods. The president is complaining that the digital services tax and the value-added tax are trade barriers, and he would like to see some more progress there. And then there's China. The road to getting some sort of engagement with China is much more it's much longer and more difficult.
Yeah, I mean, look, it's clearly there's one policy for China in terms of just how permanent the tariffs are going to be versus everybody else. Shep, some must-watch TV today. The U.S. Trade Representative Jamieson Greer is going to be heading to Capitol Hill to testify in front of a committee. We have seen some on the Hill start to push back, a bipartisan legislation being introduced in order to curb some of the president's authority when it comes to tariffs. What sort of conversation are we expecting, and just how much pushback from Congress could we get?
Well, this could be a heated morning for Jamieson Greer, the U.S. Trade Representative. He will be going there to explain the administration's trade policy, and what better moment to do so than when it's really in the crosshairs of the entire world. Not only are investors and companies concerned about this, it's also the politicians in Washington, especially Republican ones, who are concerned that the blowback may hurt them in the congressional election scheduled for next year in 2026. And we'll be looking to see how Jamieson Greer defends the policy while also hearing some of the complaints from members.
Shep, thank you so much for that update. That is Bloomberg's Michael Shepard in Washington, D.C. Now, as we mentioned, President Trump has been threatening to slap an additional 50% tariff on China due to Beijing's retaliatory tariff. Chinese Commerce Ministry responding in a statement saying, quote, the U.S. threat to escalate tariffs on China is a mistake on top of a mistake. If the U.S. insists on its own way, China will fight to the end. For more, we're joined by Bloomberg's China economy and government editor, Alan Wong. Alan, what does that fight to the end look like?
That looks like China will dig in and do whatever it takes to resist the pressure that Trump has put on the country. Just a quick reminder that Trump has threatened 50% tariffs in addition to all the previous tariffs that he already announced. So that will bring Chinese imports to twice the price of the goods entering the U.S. So with that steep rise in tariffs, China said that it will fight back until the end, as you said. And it hasn't announced just quite what measures it has or plans to use against Trump. But it has signaled that it will be digging in and will not just be coming to the negotiating table just because the pressure has become so great. And at the same time, China has given its domestic economy more support, for example, by allowing the yuan to depreciate today a little bit more than it had previously allowed. So that effectively makes exports a little cheaper and offsets some of the impacts of the tariffs.
Well, as this goes on, Alan, meanwhile, you have companies caught in the middle with global supply chains that need to figure out what they're going to do. You have Apple saying it's going to move more of its production to India away from China. And you had Shein also had similar plans to try to get around some of these tariffs and go to lower tariff countries. China, though, pushed back on that latter one. Alan, how much is in China's control when, again, it is an important market for a lot of these companies to try to stem some of the outflows of manufacturing in China?
We've seen this happen during the first trade war when Chinese factories left China and set up shop in places like Cambodia and Vietnam. So it's natural that companies this time around also thinking about doing the same. But Shein now has been caught in the middle of the US and China because China doesn't want to lose those jobs. And the Ministry of Commerce in China told Shein that it doesn't like it when they move production overseas. And Shein, in response, canceled a reconnaissance tour in Vietnam and other parts of Southeast Asia for some of its top suppliers. So it's not a good situation for Shein because as a company, it's looking to maximize profits, and obviously it want to make stuff in a place that is cheaper to sell to the U.S. market, which is a massive consumption market.
And it just feels funny that, you know, not that long ago we were talking about a Shein IPO. Just how much is that going to be put on ice? Alan, thank you so much. Bloomberg's Alan Wan. Now, as I mentioned, tariff uncertainty is keeping corporate America on edge. Apple may be the poster child for this. It's reportedly planning to send more iPhones to the U.S. from India to offset the high cost of China tariffs. That was in a journal story. Wedbush analyst Dan Ives spoke to Bloomberg about the possible move.
It would take years to even make that more than 5%, just given the logistics and the nature of India, you know, in terms of as Apple tries to move some stuff there. Look, no company in the world is hurt more from once that came out of Trump's mouth in terms of Taiwan and China tariffs than Apple.
Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, it does feel like Apple is kind of the perfect example of just how painful these tariffs are going to get. What is their ability to try to circumnavigate some of them?
Well, I mean, India is being thrown as one of the options where they could move more of their production to. But I would agree with the prior comment that, you know, relocating the supply chains would take a number of years. And in this case, I think they are probably trying to work towards getting an exception, which is what happened the last time around, you know, tariffs were imposed during the Trump administration. Apple was on that exception list. So I wouldn't be surprised if they work something out with the administration on that exception aspect.
Well, to that point, over the weekend when Scott Bessent sat down with Tucker Carlson, there was a comment that I think didn't get enough attention. And look, things change quickly, so this might not even be the case anymore. But he said, the thing to watch is not country negotiations. It is company negotiations. Yeah. Mandeep, do you need to see, in order for this to happen, more investment promised in the U.S., more manufacturing brought to the U.S. in order for Apple to get any sort of exemption on what already exists in their supply chain?
Yeah, I mean, they announced a $500 billion investment that will span a number of years. So to my mind, that's a pretty big number. And look, this is a company that does almost $100 billion in share buybacks. So could they do more in terms of capital allocation? They probably could to appease the administration, but there's no doubt that, you know, they are getting hurt. And if the goal of the administration is to work towards, you know, making these companies bigger and better, then obviously it's not helping Apple from that aspect.
Hey, you mentioned buybacks, Mandeep. Broadcom gaining this morning in the pre-market session. They announced a $10 billion share buyback, but here you have a company that also has to deal with supply chains. That's also a supplier to Apple. What do you make of that?
Yeah, look, I mean, when you look at the valuation multiples, they've compressed almost 30-40% in almost less than a week. So from that perspective, the CEO is signaling that, they find AI demand to be sustainable and they could generate enough cash flow to support a buyback. I mean, a company like NVIDIA will generate almost $100 billion in free cash flow. So from a demand perspective, I think things still remain the same in terms of AI being a secular trend and everyone being excited. So unless the CapEx numbers go down from hyperscalers, I don't see how that's changing anytime soon.
The AI trade is still there. Nancy Tangler is saying much of the same. Mandeep, thanks so much for joining us. Mandeep Singh of Bloomberg Intelligence. This is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Let's get you set up for your trading day today. We'll see if it's a calm one or another multi-trillion-dollar swing. Walgreens, they will report earnings before the bell. Then U.S. Trade Representative Jamieson Greer will be testifying before the Senate. And San Francisco Fed President Mary Daly, she will be delivering remarks at 2 p.m. Eastern. We're also going to get some Treasury auction. That includes $58 billion of 3-year notes later today. Well, I mentioned, is it going to be another chaotic day? Look, this market does really impinge on just one man's word, and that is Donald Trump's. But some of the tea leaves coming out has been, we're negotiating with the likes of Japan, and that's enough to get your pre-market session to look like this. We're up more than 1% across the major indices for your futures in America. All right, that is it for your Bloomberg Brief. Surveillance will take the reins from here. You're watching Bloomberg.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is not an external pressure catalyst on President Trump right now to pull these tariffs back.
Not only do they cause this uncertainty, but they also raise prices, that you see inflationary impacts from them.
The problem for the president is that a lot of world leaders are not quite sure that they can negotiate with him. They don't want to be embarrassed.
There's still a lot of moving parts to this.
The president's asking the American people for a long leash, and we'll see if the American people give it to him.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday following a wild 24 hours in financial markets, rumors flying that President Trump was considering a pause on tariffs, slapped down by the White House. Levies are set to go into effect shortly after midnight tonight. 20% on Europe, 24% on China, 34% on China, 24% on Japan. The administration doubling down on China. President now threatening an additional 50% import tax on the nation. The Treasury Secretary leaving the door open for everybody else, saying over 50 countries have responded. We look forward to meaningful negotiations with them over the coming weeks. So the question hasn't changed. It remains the same. Is it a negotiation or is it a new rule for the game?
And the fact that we are still asking that question, I cannot answer that question because nobody can answer that question. The fact that we are still having that question is really the reason why you saw a $2.5 trillion swing in the S&P 500 in the span of 15 minutes yesterday. What is the lesson from that? The lesson is don't take risk. Don't take risk in stocks and don't take risk in bonds because your face may get ripped off.
The pendulum swinging from one idea to the next, and in between you can do a lot of damage, and I think we've seen the damage done potentially for the economy in the months to come.
Absolutely, and the pendulum has been swinging. One thing I take of note, though, is yesterday the Treasury Secretary coming out on a network, on Fox News, but also on Twitter, talking about the fact that he is going to be leading negotiations, starting with Japan. And that makes you think, potentially, this is the start of negotiations for a number of trading partners, except for one. China. Overnight, China with some tough words when it comes to the United States, saying that the U.S. threat to escalate tariffs on China is a mistake on top of a mistake, and they will, Jonathan, fight to the end.
Vietnam offered to drop tariffs, rejected. The EU's come out and offered to drop tariffs on industrial goods, rejected. Is it clear what these countries need to provide to this administration?
In a word, no. And I think pretty much everyone across the board doesn't have a clear understanding, and part of that is because there are competing ideals in the White House about what the goal actually is. You have some people talking about the trade deficit, getting it down to zero. You have other people saying, actually, it's just about getting a better deal for the United States to increase production here. In the meantime, markets are reeling, and it's hard to know when stability is going to come back into play.
Equity's doing better so far this morning, at least. Good morning to you all just tuning in. Over the next 60 minutes, we'll catch up with Peter Oppenheimer of Goldman Sachs after a wild 24 hours in markets. John Lieber of Eurasia Group as President Trump plays tariff hardball, and Skylar Montgomery-Koenig of Barclays on why investors are in max bearish dollar territory. We begin this hour with stocks pushing higher, looking to snap a three-day losing streak as countries rush to the negotiating table. Peter Oppenheimer of Goldman Sachs writing, we would argue that we are in an event-driven bear market triggered by tariffs. However, it could easily morph into a cyclical bear market given growing recession risk. Peter joins us now for more. Peter, welcome to the program, sir. It's good to see you. What's the difference between the two? Why is that distinction so important this morning?
Well, actually, the distinction is not that much when you look at the typical falls that you tend to get. In both cases, the falls on average in equities are roughly about 30%. There's a reasonable distribution around that. That's the average. But mainly, they're distinguished by how long it takes for the market to fall and then recover. And in what we call event-driven bear markets, that process is a lot faster. What's the difference between the two? Well, event-driven bear markets, as we call them, is something that's sort of triggered by an exogenous shock, an event like tariffs, that really just forces the economy off its previous track. Whereas a cyclical one, the most common type of bear market we see in equities, is really about recessions. So the critical thing from here really is to what extent investors really start to fully price a recession, which would imply profits fall and equity valuations have further to decline.
Peter, I guess we're trying to figure out how much the damage is being done by just simply uncertainty and how much the damage is being done by actual profit margin contraction, by consumers facing off higher prices. Which is the bigger impetus for some sort of recession at this point in your mind?
Well, I think one of the triggers here, as you say, is uncertainty. In the end, uncertainty is the enemy of activity and of risk assets, because what tends to happen is that both investors and companies, as well as consumers, tend to just hold back. Decisions are pulled, and that results in slowing activity. But obviously, as economies slow, then you tend to get other sort of factors that come into play. Now, the good thing, I would say, is that there are some important underlying supports of economic activity. Private sector balance sheets generally are quite strong, both corporates and banks. Of course, there's also room generally for central banks to be cutting interest rates, which will be helpful in time and is usually one of the necessary conditions before equities really recover from a bear phase. But I think at the moment, this is really about uncertainty and about investors trying to calibrate how far economies slow and for how long.
Yesterday's price action was interesting to me, Peter, because it highlighted the fragility of the liquidity in the market on all sides. Just this idea that why would anyone have conviction to buy right now when you could be blown out of the water by just simply a headline that is unsourced, that comes out and then gets reversed 15 minutes later. How much is that kind of volatility, if it persists, enough for you to actually lower your forecast yet again for the S&P?
Well, I think the critical issue here, again, comes back to whether there's likely to be a recession or not. Our economists believe that the probability of a recession in the US, for example, over the next 12 months is now around 45%. But indeed, if the full expected tariffs come through and there is no pullback, that would likely trigger a recession. And look, in a recession, typically profits do fall anywhere from sort of 10 to 20% or more, depending on what industries they're in and in what regions. And of course, if investors start to price that as a likely outcome, the most likely outcome, then equity indexes have further to decline as they price in lower profits and probably a lower valuation as well. So, you know, we still have downside in the short run in our targets. But I think also the sort of conditions you're likely to see to really sustain a base in equity markets for a proper recovery and not really yet there, I would say.
Peter, at the beginning of this year, there was this idea that if the U.S. didn't enact tariffs, you would end up seeing the pain more greatly around the world, particularly in Europe, maybe even in China. That has been shifted, although now we seem to be heading back to that kind of idea. Where do you stand on this? Do you think that the U.S. is the epicenter of pain, or simply a part of a global trend that is not going to leave really any bright spots?
Yeah, I think it's interesting the point that you raised there. I mean, certainly when we surveyed investors early this year, asking them about what they thought the impact of US policies would be, it was very much a focus on being negative for the rest of the world, particularly Europe and China, as people focused on the impact of tariffs, but would be really quite positive for the US because people had in mind the potential for tax cuts and for deregulation. And while that potential still exists, what's happened, I think, in the US is that the focus has very much shifted toward the impact of tariffs in the US, both in terms of higher inflation and investment and growth uncertainty. So it's really now become a sort of global issue, engulfing the world in this uncertainty and therefore raising the risks of an economic shock that hits profitability and profit margins more broadly.
Peter,
and so, yeah.
Well, we heard from the Treasury Secretary yesterday who talked about how the president gave himself maximum negotiating leverage, and now Bessent with Jameson Greer will be leading these negotiations, starting with Japan. Does that give you some sense of optimism? Can you put this genie back in the bottle?
Well, look, anything is possible. We know that the tariffs are about to be enacted, but of course there is room, I think, for negotiation, and that's the signals that have come out of the administration. But again, negotiations can take a long time and can be quite complex, and that's going to create an environment of uncertainty, at least for a period of time. But also, I think it does demonstrate that we're in a changed sort of global environment in terms of the world trade architecture, and this was already beginning to shift in the months that followed the pandemic, as companies around the world tried to diversify supply chains. So we're in a less globalized environment. That's going to put some downward pressure on world trade. And of course has implications both for inflation and growth. But I think it is, of course, possible that this is part of a tactic to negotiate and come to agreements, but we've got some time yet of uncertainty. Bear in mind also that we came into this year with relatively high valuations in risk assets, both in equities and credit. They were not pricing much downside risk at all. We're still in the process of that adjustment coming through.
Talking about valuations, and that's really where I wanted to end, was this idea of large cap tech stocks that seem to lead the way. And there was sort of a hint that maybe they could lead on the way up yesterday, but some of the damage has been pretty impressive. I mean, Apple, for example, has lost almost $640 billion of market capitalization since the end of the day on April 2nd. That's about 19% of its value. Do you see big cap tech leading again global stocks, given the fact that we are seemingly in a new world order?
Yeah, I think it's an interesting point. When we came into this year, our strategy was very much about diversification, both geographically, given the huge dominance that the US market had sustained up until that point, but also across sectors and factors. And we really emphasized the risk, in a sense, that the US market had become so dominated and concentrated in a small number of super large tech companies. Of course, what we've seen since the beginning of this year, aside from the slowdown in growth expectations, is that some of the big tech stocks have been hit as you've seen new competition emerge, particularly from China. But to be clear, these companies are very profitable, they have very strong balance sheets, they're very cash generative, and in that sense, pretty defensive. And we've also done some work, comparing the technology ascent that we've seen in recent years to the period of the tech bubble a quarter of a century ago, and there are some major differences, particularly in terms of valuation. These large companies are nowhere near the sort of bubble-type valuations that we saw a quarter of a century ago. around the internet, or indeed in other bubble periods in history, like Japan in the late 1980s. So I think that the tech sector is still going to be a very important cornerstone of the recovery in equity markets as it comes through. And many of the biggest companies are relatively defensive in terms of their balance sheets, and that's an important factor, I think, to bear in mind.
Hey, Pete, good to get your thoughts this morning. Peter Oppenheimer there of Goldman Sachs. Thank you, sir. If you are just joining us, a bit of stability. Equity futures on the S&P positive by 1.2%. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. U.S. small business optimism fell last month by the most since June of 2022. The share of business owners expecting better conditions in the next 6 months fell 16 percentage points. That's the steepest slide since December 2020. NFIB's chief economist said that it's Trump policy leading to the increased uncertainty. Billionaire Ken Griffin says that President Trump's latest tariffs are a, quote, huge policy mistake and a tax on families that will increase costs for everyday items. Griffin, who is a Republican megadonor, urged people to reach out to Trump to reconsider his tariff policy. Now, speaking of Apple, President Trump's threat of new tariffs has caused a surge in Apple Store customers. They're panic buying iPhones due to concerns of price increases. Apple's U.S. retail stores saw higher sales over the weekend. Employees there described the atmosphere as similar to the busy holiday season. And that's your brief. John.
Hey, Danny, thank you. More from Danny later on in the hour. Up next on the program, tariff confusion.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many, many countries that are coming to negotiate deals with us, and they're going to be fair deals.
Up next on the program, John Lieber of Eurasia Group, live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Lisa Shannon of Morgan Stanley saying it was like firing the bazooka into the dark. That's what it's been like over the past few days. Equity futures on the S&P 500 bouncing back positive here by 1% on the S&P. On the Nasdaq up by 0.8. Under surveillance this morning, tariff confusion.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many, many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs. They don't want to be in the hands of the Chinese. And The Chinese have turned out to be really not very good at that. People that are with us, they're with us, but we cannot be taken advantage of any longer.
So here's the latest this morning. President Trump offering little clarity on what he is seeking from trading partners in exchange for lower tariffs. The president leaving the door open for talks, but also threatening to impose an additional 50% import tax on China. Bloomberg's Tyler Kendall joins us now for more, alongside Ollie Crook as well. Tyler, first of all, to you. Set to kick in later on tonight. Is there space to negotiate here or not?
Yeah, good morning, John. Really big questions about what this White House is really looking for. And the administration seems to be signaling that it's going to take some time to negotiate as President Trump rules out a blanket pause. Now, I had the chance to catch up with Treasury Secretary Scott Bessent yesterday, and I asked him if we could expect any deals ahead of tomorrow, and he said likely not. However, when I did ask him if the White House was considering lowering that current 10% tariff floor that's in place, he said that everything is on the table. So if everything is on the table, then of course the big question is, what does it really take to clinch a deal? And it's becoming increasingly clear it's going to take more than just lowering tariff barriers. Take yesterday as a prime example. Israeli Prime Minister Benjamin Netanyahu, the first foreign leader to come face-to-face with President Trump since his tariff announcement, he pledged that Israel was going to not only eliminate tariffs, but also eliminate Israel's trade surplus with the U.S. And when asked if that would be enough, President Trump said maybe not, and that was considered to be the more friendly approach. Of course, he mentioned China there, which in a statement earlier today had some pretty tough words. While saying that they would prefer dialogue to resolve disputes, they did vow to fight to the end as this rhetoric continues to escalate. And John, I would just mention one other important piece of reporting from Bloomberg News yesterday. It appears, according to sources familiar, that there are no established systems in place for companies and countries alike to register their complaints at Commerce, the USTR, or the NEC, which is further raising this confusion.
Oliver, let's bring you in here. Trump said yesterday the offer from European Commission President Ursula von der Leyen was not enough to reset transatlantic relationships. So how are the Europeans approaching Washington now?
Part of the problem is they have no idea what is enough to reset that trading relationship, as you were alluding to. You know, the European trade ministers assembled yesterday in Luxembourg to really get that collective response, the first really to this latest round of tariffs from the Trump administration. They have Plan A and they have Plan B. Plan A is a negotiated outcome for the end of tariffs. This is what basically everybody in Europe would like to see happen. The reality of the situation, though, when you speak to these trade ministers, you say, do you get the impression that the Trump administration is in any mood to talk? The answer is no. Do you have any idea of what the sort of non-monetary barriers specifically you'd like to say he'd like to see reduced in order to get a deal? The answer is no. That takes us to Plan B. Plan B is a much more full-throated retaliation against the United States that includes not only tariffs, also includes potential taxes on services, taxes or regulations on tech companies, and that is the plan that is being slowly assembled now. That being said, what the European policymakers are doing right now, the word of the day yesterday was de-escalation. They want to create as much runway as possible to have these negotiations with the Trump administration. Next week, we understand we are going to get a measure of retaliatory tariffs. That is just on aluminum and steel. That will be fairly modest, but they're trying to give themselves as much space to communicate with an administration that, frankly, so far seems to have no interest in speaking to them.
Ollie, thank you, sir, for the update. More from Ollie coming up later on today on Bloomberg TV alongside Tyler Kendall. John Lieber of Eurasia Group joins us now for more. John, Vietnam made an offer, rejected. The EU reportedly made an offer, rejected. Do you have a decent idea of what this administration would like to see?
I mean, I think they want to see manufacturing coming back to the United States. And so they're not interested in offers. They're not interested in other countries lowering their tariff barriers immediately. What they want is a long-term plan to send a signal to the market that the U.S. is now planning to source from the U.S. And that means they have to commit to this durable tariff regime. And that's a really bad sign for other countries that want to come in and do deals. And it's a really bad sign for global growth and the U.S. economic outlook.
John, how long would that actually take?
Years. I mean, I don't think anybody thinks this is going to happen overnight. You've got 80 years of supply chain deepening going on around the globe that the Trump administration is now trying to dismantle piece by piece. Now, we do think there is some room for these tariff barriers to come down. If you remember Trump's campaign, he campaigned on 60% tariffs on China and 10% tariffs on the rest of the world. We're above that currently. And so, there's still a lot of space for these individual tariffs on individual countries to move downward. I do think that 10% floor remains in place. And I think this is going to be a really lengthy process as other countries try to figure out, they're probing here, trying to figure out who they can talk to, what they can offer the U.S. The U.S. is giving them no signals of where relief is going to come from. But eventually, I don't think Donald Trump or his political coalition can handle the kind of political and economic pain that's going to follow from these tariffs. So they are likely to come down at some point, but it's not going to be this month. It may not even be this quarter. So we could be in for a long period of pain here.
Well, for the first country that's going to be able to at least get to the negotiating table, Japan, the Treasury Secretary said yesterday he and Jamieson Greer, ambassador of USTR, will be at the table having that negotiation. Is that a sign to you that if you want to get a deal done, you have to now go through the Treasury Department?
Not necessarily. I mean, I think there's going to be, Scott Bessent's only one man, and he's got a team in there. But there's a lot of countries that have to be negotiated with here, and the USTR has typically taken the lead on that role in these negotiations. I think the Japanese really wanted Bessent to be the lead negotiator. They think it's a sign of their importance in the U.S. trading relationship, and I think there's diplomatic reasons to make the Treasury Secretary the face of that particular negotiation, but I would expect going forward that the USTR has a much bigger role here.
When it comes to China, we had a statement from the Commerce Ministry overnight from Beijing talking about the fact that if the U.S. insists on its own way, China will fight to the end. They're also calling for a dialogue to resolve the disputes. They said this in a statement. At what point do you see Beijing and Washington coming to the table and having this discussion?
I'm not sure. It's really difficult to say right now. I think that you look at the tit-for-tat escalatory cycle of what's happening here, and I think that there's just not a lot of deal space. I think the Chinese are probably correctly assessing that they can withstand their political, the stability of the regime. Leadership can withstand a lot more disruption than the United States can, given how, we have elections here. And Trump's popularity is almost certainly going to go down, and that's going to start to cost him on Capitol Hill. That's going to cost them in the midterms next year, and that's going to cost the Republicans in 2028 when the elections happen. So if I'm the Chinese, I think I've got a lot of ability to withstand this. They've been preparing for tariffs for a long time, and they seem very comfortable to be in a position where they're retaliating against the U.S. in order to weaken, and the end result is weakening the U.S. economy and weakening Trump. And I think that's what's going to happen here. And I think the Chinese have the ability to remain dug in, and that doesn't leave a lot of deal space.
John Labour, Eurasia Group. John, wonderful to get your perspective on things. As always, Senator Cruz going into the weekend did start to push back against some of this. Has he got company on Capitol Hill?
Well, he's talking about the fact that he thinks that, one, this is going to be potentially damage when it comes to the economic pressures for American families. And then he's thinking about, of course, 2026 and the midterms. And he said that if this damage continues, there will be a bloodbath. Today's going to be very interesting. You want to know about other people that are joining him? Let's see what the questions look like to USTR's Jamieson Greer, who's going to be on Capitol Hill in front of the Senate Finance Committee today, trying to explain the mixed messages we're hearing out of this White House.
And the methodology that was used to put these major tariffs on these countries that are set to kick in overnight.
Which has defied a lot of logic and really raised the question, is it really ultimately the trade deficit and a formula that potentially some places might not be able to complete?
We'll catch up with Stephen Myron, the chair of the Council of Economic Advisors at the White House, a little bit later on this morning, so look out for that. And next on the programme, Skylar Montgomery-Koenig of Barclays on why investors are in max bearish dollar territory. That conversation up next.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
So many downgrades to equities over the past few days. Evercore, JP Morgan, Oppenheimer, Bank of America, BlackRock has joined the party. HSBC and Max Kentner. Check this out for a quote. The one thing about that we've been wrestling with ourselves in recent days is whether we're actually bearish enough. I think that speaks to the moment we're in at the moment. Live from New York City, welcome to the program. Bouncing back a touch on the S&P 500. Off the back of that three-day losing streak, up by 1.3% on the S&P. On the Nasdaq, up by 1 full percentage point. Let's get you some morning movers. We can do that with Danny Berger. Hey, Danny.
Hey, John. Easily the best performing stocks in the pre-market are moving not just because of tariffs, but it is health insurers. CVS among them, up more than 6.5%. After the market closed yesterday, the Trump administration offering bigger payouts via Medicare to the private insurers to the tune of $25 billion. They say it's because higher prices, but that exceeds even the most optimistic scenario laid out by analysts. So Humana, CVS, United Health, all of them rallying. Broadcom also putting out a $10 billion buyback into the market. Those shares up nearly 3%. Remarkable for a company which is a semiconductor company, very exposed to international supply chains, very exposed to Apple. It is a big supplier for them, but the company's saying we are confident. And by the way, after a 15% slide, the stock a whole lot cheaper to buy back. Rounding things up with Levi's this morning, because this is one of the first retailers to provide us with a sense of earnings after Trump announced tariffs. You can see by the rally what they said was interesting, 13% higher, saying that they are keeping their forecast for 2025. A hold-on forecast is enough to get this market excited because there's so much expectations for downgrades. The rub, though, this assumes no deterioration in the macroeconomic environment. They said that they don't even know how to incorporate tariffs, and they've assembled a task force to try to do so. John.
Danny, thank you. That's a major assumption. A major assumption. Can you imagine if the rest of the companies this week, the banks come out of that on Friday? Here's our guidance, but we don't assume any change to the macro environment. What kind of guidance is that?
That's not a guidance. And frankly, that would leave a lot of people wondering how clueless they actually are, given the fact that every economist across Wall Street has downgraded their expectations to growth. How could that not affect what consumers are going to end up doing? I would like to see guidance in that task force. Good luck.
On our radar this morning, our top story, China vowing to, quote, fight to the end as President Trump threatens an additional 50% tariff. The blunt reaction from the Chinese Ministry of Commerce suggesting Beijing will resist short-term negotiation.
So you're seeing the tit for tat really take place when it comes to Beijing. What is interesting is Trump with this warning that if China does not withdraw its 34% increase, which comes into effect in 2 days, April 10th, the U.S. comes into effect April 9th. That means in cumulative, the levy on China for some products will be north of 100%. That is why today I think it's really interesting to hear what the likes of Jamieson Greer, the president, has to say when it comes to Beijing specifically.
The contours of an off-ramp, if we can call it that, was slowly coming together yesterday if the president wants to take it. And of course, it's up to the president, just one man that gets to decide here. If you have a look at what the president said yesterday about doubling down on China, followed up by Secretary Besson out on X, who posted the following: China has chosen to isolate itself Over 50 countries have responded openly. We look forward to meaningful negotiations with them. And if you go to the FT op-ed that we had from Peter Navarro as well, there's a line in the FT op-ed right at the very end that said, we will want to hear from countries including Cambodia, Mexico and Vietnam that you will stop allowing China to evade US tariffs by transshipping exports through your country. So I got a real sense yesterday, I think we all did, that they were coming together to isolate China, double down on them, and open the door to everyone else. That seems to be the off-ramp that's coming together.
Which it really raises the question, what does ultimately a decoupling, a full decoupling, a more concrete decoupling look like between the US and China? Are we actually considering that? Because if there is no off-ramp, and you have China doubling down as well, at what point can you maintain some of these international businesses? And that's the reason why I keep watching Apple shares, because that is one stock that is massive, that really depends on the Chinese economy and production in that region.
I'm glad you mentioned Vietnam and Cambodia, because Xi Jinping is headed there in a few days. These are the countries he's going to, and these are the places where Chinese manufacturers had went to try to avoid any retaliation, seeing the writing of the wall of potentially Trump coming back into office. But now those countries are getting hit with tariffs. Why? Because Trump wants to make sure he is sending this message to China and Chinese manufacturers.
I want to be very clear that these are the contours of an off-ramp that might not be taken or built. This is what JP Morgan said. The fate of the equity market is essentially in the hands of one individual who can unilaterally ease or deepen this shock, and I think we all agree with that. The billionaire Ken Griffin calling President Trump's tariffs a, quote, huge policy mistake, saying the levies amount to a huge tax on middle-class consumers. Griffin adding that bringing back US jobs is a, quote, 20-year dream, not something achieved in 20 weeks.
This goes to the question of strategy, execution risk. You might want to bring jobs back, but how do you do that if you've got policies that go on overnight? This is really important because Ken Griffin is a super donor to Republican Congress members, to the Republican presidency. So if he's coming out and being so vocal about this alongside Bill Ackman, alongside a whole host of other business leaders, at what point does that get people's attention?
Lisa, you mentioned Apple, so let's get the latest on Apple as well. Planning to source more iPhones from India to offset the costs of China tariffs. The Wall Street Journal reporting the adjustment is a stopgap as the tech giant tries to negotiate with President Trump for an exemption. I look back to that interview that we did with the Commerce Secretary, Howard Lutnick, before he became the Commerce Secretary. He sat around this table in campaign season and said there will be no exemptions. I wonder how different things might be for Apple this time around.
Well, this time it seems as though they are more exposed than they have been previously, especially because of what we were talking about between the escalating tit for tat between the U.S. and China. They are doubly exposed. Their sales in China as well as their manufacturing in China. And there is a meme going around of people on Wall Street sitting next to each other working on iPhones. And it's sort of this comedy, but at the same time, you put these two together, how long does it take to move some of these production change and how expensive is it? Apple's trying to start to get ahead of that on some capacity.
Well, if they don't move production, the only people affording iPhones are the people working on Wall Street anyway, because they'll be about $3,500, right?
That's pretty much where we're heading. And that's the reason why people say it's going to take $20 billion to move just 10% of the supply chain over to the U.S., and it would take 10 years to build that out. So for Apple, it's a pretty big cost, and it's coming at a time where they don't have the time to execute.
I imagine it's that $3,000, $3,500 iPhone that potentially could be the future, that Tim Cook goes to the White House and says, look, do you want Americans paying for this? They're not going to pay for this, and it's going to be backlash on you politically. I imagine that's one of the chips he's going to use, but Howard Lutnick said no carve-outs, no exemptions.
Finally engineered the upgrade cycle over at Apple, though, didn't we? Apparently the stores are packed. Stockpiling iPhones.
Well, I'm stockpiling wine and olive oil.
Getting ready to sell them on the black market.
Well, all I can say is maybe our kids should be on their phones less. Maybe we should all, okay, I'm going to stop there. But I'm just wondering, at what point do people just get used to a little rough, a little around the edges?
Are the kids tuning in today? Was that directed at them?
It's okay. Just put your phone down. Read a book.
Apple's up by 1.4%. Let's turn to foreign exchange. The US dollar under pressure ahead of President Trump's tariff rollout. Skylar Montgomery-Koenig of Barclays writing, dollar negativity is now consensus, and our sentiment index is in maximum bearish territory. Historically, this has been a fairly reliable reversal sign. Skylar joins us now for more. Skylar, historically, I just wonder how different this time might be.
Yeah, I mean, it's interesting because I think the reaction to tariffs was unexpected for the dollar. All else equal, we know that U.S. tariffs should boost the dollar. But I do think there's a logical explanation here in that, our import substitution model shows that dollar strength does occur on U.S. tariffs, but it also shows dollar weakness if all tariff countries respond in kind. Because in that situation, a larger share of U.S. exports would be tariffed than, say, Europe, which only has new tariffs on exports to the US. So this tells us that within FX, we're reliant on how the economies respond to US tariffs. The second point has to do with growth and confidence. I think there's this growing concern over US policy. From an economic perspective, tariffs are not wrong if there's an existing distortion. But sweeping tariffs with very little nuance are clearly suboptimal, and they raise recession odds. US growth was already slowing with confidence under pressure. And the one clear conclusion from tariffs is that they are US growth negative, whether they stay in place across the board or renegotiated in some places or not. On the other side, that means if there is also likely still some hope that there are deals, and we don't know where those deals would be yet. So I think that reflects some of why you have this dollar downside, but I think it's very hard to maintain an environment of slowing global growth.
Skylar, one thing we've discussed on this program repeatedly is not just the shock to the cycle, but the potential shock to the system. We'll catch up with Stephen Myron later, the chair of the Council of Economic Advisors at the White House, in about an hour from now. And one thing he said, particularly in the last 24 hours, is that the security umbrella that the United States has offered the world, together with reserve assets that facilitate trade, he's making the point that that's distorted the US dollar. There seems to be a pushback against the system. And is that something that we can fully internalize now? I don't think so. But in coming weeks and months, coming years, how are you thinking about those changes?
Yeah, I think because we have these great worries over U.S. policy, they have brought into question the role of the U.S., and it's brought into question the role of the dollar in the global system. In this market narrative around a broad reallocation away from U.S. assets, and that in turn putting pressure on the dollar. We think it's too early to make that call. At minimum, I think for money to move to foreign markets, you need some kind of improved asset returns in these markets, which seems like a very high bar with global growth slowing. So for example, in China, margins are mid to high single digits. Tariffs on the scale the U.S. is imposing pretty much completely wipe that out, even if you pass a significant portion of that on to the consumer. For bonds, U.S. yields are still relatively attractive, while there still isn't a large liquid alternative market. This is also not the first time that the market has falsely gotten excited about this narrative, and it wasn't sustainable. We've had more than a decade of policy that's very much favored the U.S., and it's very hard to undo that. So I'll maybe just finish off by saying that, even if it is the start of a massive rotation, that's something that will take a decade or more to play out. So there's still time to position for it, and you don't need to take on the early signal in case it's false.
How do you get ahead of the idea that maybe China will allow the renminbi to weaken disproportionately to offset some of the damage that we're seeing or potentially increase their export power?
Yeah, I think that's kind of our base case in terms of China. One of the places that rhetoric on trade has been very clear. Tariffs have gone into place. They're very large in scale, and they've only escalated since Trump has been in office. Authorities in China have been artificially supporting the currency, so current tariff rates imply that dollar CNY should be much, much higher than current levels. And there is this view that they won't let the currency go because they're worried about capital flight. But capital flight will also leave if the growth outlook deteriorates significantly, even if you keep the currency steady. So when the economy deteriorates, they can either take the hit, moderate it via significant subsidies, or they can let the currency go. And they've been unwilling to do large-scale stimulus or enough, at least, to really prompt the consumer to spend again. So we think it's more likely that they do let the currency go, and in part to support their export market. And so we do like being long dollar CNY, and our target on that is around 750.
Skylar, there's this question about how Europe will respond, and we were talking about the haven status of the U.S. and just how fundamental it is to the overall system. In Europe, they are planning to do fiscal stimulus. There could potentially be other offsets, regardless of whether there's a deal struck. How do you calculate the fiscal impulse into at what point the euro could potentially strengthen in a more material way?
Yeah, so I think the euro in the last week or so, it's benefited from the fact that it's a liquid alternative to the dollar. It's more trading off of U.S. center negativity more than it's trading off of Europe's positives. And now there's this tug of war between tariffs and the fiscal response. And by that, I mean, we do expect U.S. tariffs the European economy into recession. That's definitely net. But we've already seen large-scale quantify that as you can look at fiscal, and around 1% of GDP in fiscal expansion is around 30 to 35 basis points on the long end. You can then take the beta between yields and effects to find what kind of policy response feeds into euro-dollar. So for us, we're very much waiting on what the size of that stimulus is to have an idea of where we think euro-dollar fair value is. But you also need to consider there are other components, right? If CNY weakens materially, that will also put downward pressure on euro. So you need quite a big fiscal stimulus, I think, to offset the tariffs that we've seen, with one measure saying that, the fiscal that we got from Germany already adds around 40 basis points to European growth, but a 5% tariff takes away 40 basis points, and we're at 20%.
Hey, Scarlett, we've got to leave it there. Appreciate your time. Scarlett Montgomery-Koenig there of Barclays. Thank you. So if your equity market's getting hammered at the moment, you have one or two choices. You can negotiate or you can intervene. Taiwan Stabilization Fund deciding to support the stock market. That headline just crossed in the Bloomberg. Intervention's one option. Negotiating's another. Japan coming to the table, and look at what happened to the Nikkei 225 overnight, up by 6 percentage points at the close in Japan this morning.
There was some conciliatory language coming from both Scott Bessent saying that he had productive conversations with the Japanese, as well as President Trump, who said that he did feel good about his conversation with the Prime Minister there. It does raise the question, and it goes back to which countries is this administration willing to negotiate with? It seems like Japan, sure. Mexico, Canada, we're getting to somewhere. Europe, where does Europe get left in all of this, given some of the harsh rhetoric and the personal aspect of cars and meat and cheese that seems to be coming out of the White House?
A rock and a hard place at the moment between China and the United States. Equity futures up by 1.6% on the S&P. On an update on stories elsewhere, with an update, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China is urging fast fashion retailer Shein not to move its production out of the country. People familiar telling Bloomberg that the Chinese Ministry of Commerce has discouraged Shein and other companies from moving their manufacturing to other countries in reaction to President Trump's tariffs. BlackRock CEO Larry Fink said most CEOs that he talks to think that the U.S. is already in a recession. Fink warned that stocks could keep falling as President Donald Trump's tariff policies destabilize the world economy. Speaking at the Economic Club of New York, Fink said in the long run, this is more of a buying opportunity than it is a selling opportunity. New York City's congestion pricing program is likely to remain in place for the next several months. The MTA and the Trump administration have agreed to a timeline that would keep congestion pricing tolls on through late October as both parties await a ruling, according to court documents. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the program, repricing the Fed put.
If we have something that's both deteriorating economic growth and driving up the prices, that is to say something that is stagflationary, there's not a generic answer to what the Fed should do in response to that.
The Federal Reserve is not racing to step in. Up next on the program, reaction from Earl Davis of BMO. Live from New York, you're watching Bloomberg TV.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
The world is truly upside down. Communist China. Out on X yesterday, the Chinese embassy posting a video of Ronald Reagan arguing against tariffs back in the late 80s. Can you get your hands around that? Get your head around it?
At this point, the trade system as it is benefits China. They would like to preserve it, and there are a lot of people in the U.S. who also would like to preserve it because their businesses run on it. So there you go.
They want the walls up at home, and they want the walls down everywhere else.
You know,
This
is going to be the crux of the reason why this is so difficult to negotiate.
And this is why they're going to try to take advantage of America's closest allies, like the European Union, in this time to try to forge closer relationships, because they need a market to dump on as well and continue to dump on. And the European Union at some point is also going to say, we need fresh markets as well. If we can't go to the United States, we're going to have to keep going into Beijing.
Oh, the hypocrisy. Equity futures right now in the S&P positive by 1.4%, bouncing back by 1.2 on the NASDAQ. What happened in the bond market yesterday? Why were yields up so much, even with risk down through most of the session? We'll talk about that in just a moment. Yields are lower this morning. We're down by 2 basis points on a 10-year, 415.67. Under surveillance this morning, repricing the Fed put.
Our job is to look at the hard data, and if we have something that's both deteriorating economic growth and driving up the prices, that is to say something that is stagflationary, there's not a generic answer to what the Fed should do in response to that. Depends how much it drives up prices, how long it's going to last, and how much it reduces growth.
So here's the latest this morning. Fed officials not rushing in to support the market, facing down downside risk to growth and upside risk to inflation. Earl Davis of BMO writing the Fed will ease by 50 basis points at or before the next FOMC meeting. Earl joins us now for more. Earl, that one's punchy. And some people agree with you. Bob Michael at JP Morgan made a similar point on Sunday evening. What gives you the confidence, given what we've heard from Fed officials, that they'll do something different to what they're saying?
Yeah, no, we do believe that growth and inflation are the major discussion points at the Fed, and you're hearing them discuss both and debating both. We add one more point to their decision matrix, and that's, the sentiment of the populace. And the reason why we put that in, like, the U.S. is a consumer economy. You don't get spending unless you have certainty. If we're not going to get certainty on the policy or in regards to the retaliatory response from other countries or the fiscal side, you get it from the monetary policy side. So we think the combination of growth, which it will definitely be lower, plus consumer sentiment getting more fearful and lower, is the thing that turns the Fed towards easing. The 50 basis points of easing, the reason why we feel that is that, it was heading into Liberation Day. We thought that last week would be the week of peak uncertainty. It was not. So because of that, we haven't hit peak uncertainty yet. We believe that if and when the Fed goes, they will go by 50.
Earl, is there a warning shot sent by, frankly, what we saw in the market yesterday with 30-year yields widening out, rising at the fastest pace going back to the pandemic, that if the Fed does move, that maybe the reaction in markets won't be what they're looking for?
I think you can look at it that way. I don't look at it that way as an active manager. The reason why I don't look at it that way is that you have to always understand who's your marginal buyer or seller in the market. They are the ones that set the price. So I'm not a believer that the price or yield that you see is a reflection of market expectations. It's a reflection of that marginal buyer or seller. Now, going to yesterday, the next question you have to ask is understanding who the marginal buyers and sellers are. Yesterday was what you call an uneconomic seller. They don't care about prices. They don't care about losses. There's two types of uneconomic sellers. One is the deleveraging seller. Someone who has a lot of leverage in the market, gets a tap, is no longer on the desk, so the shop closes the book, and they just sell to get out of the position. The other one is, as you've heard, the possibility of foreign selling. To be determined which one. Right now, my default is that it was the first, not foreign selling, but the first. So what's the difference between the two? If it's like a hedge fund manager or something, positions being closed, the persistence of that's very short, which says you could have a quick snapback here. If it's foreign selling, you would see continued, and we could go towards 450 if it is. I do believe the Fed would step in because the plumbing of the system is no longer working at that level, and they will step in to stabilize the plumbing and have proper market functioning. It is one of their roles. So for that reason, we believe in 10s, US 10s at 420 to 450 is a buying level. We see the longer term range from 450 to 350.
This is really a huge bet on the Fed and on the Fed put. At what point do you think this is different, especially that maybe this Fed has learned a lesson from the previous times that it either hasn't hiked rates or hasn't cut rates, but really has underestimated inflation consistently?
Yeah, the challenge the Fed has, it's almost like a triage. You got to deal with what's the most deathly symptom at the time. Not to say that the longer term impact of doing that will be beneficial. So there is a risk. So when do bonds really sell off? I believe if the Fed does 50, and does not introduce QE again, you have the real possibility of 10 years and 30 years selling off because of risks of inflation. If they do QE, I think it maintains it for a while. And I think the objective of doing this, cutting 50, doing QE, is to move money off the sidelines, 7 trillion plus in money markets. Move it off the sidelines, move it back into investment and growth. And you saw that through QE, through driving real yields into the negatives. I think that will be the game plan from a medium-term perspective to get growth going. Then they don't have to ease as much following that. But it is weary, and it's not easy. So I'm not saying, but just given my history, like I said, I've been 30 years an active manager in the market. This is the dynamic and the mechanisms I've seen in the past, and this is what my expectation is right now.
Oh, appreciate your opinion on it. Thank you, sir. Earl Davis there of BMO on the bond market. Those moves got the attention of all of us, and I'm sure for all of you as well, sitting at home watching it. We've been talking about it for a while on this program. What would happen if equities, risk, gapped lower, but bond yields started to climb? Does it speak to foreign selling? There's one reason alone why I think you can take some comfort that wasn't happening yesterday.
The dollar.
The US dollar. Did not see that accompanying dollar weakness that you might expect if that was the case.
And that's the reason why people said maybe this is just margin calls, maybe this is just banks for de-risking.
We're going to see, but it's certainly one to keep on your radar, that's for sure. Up next on the program, Julian Emanuel of Evercore, Alex Norister of the Cato Institute, Dan Stroyven of Goldman Sachs, and Stephen Myron, the chair of the White House Council of Economic Advisors.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like this speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
When you look at these moves, we describe it as a bang and a whimper. We're in the bang phase of this drawdown.
We went from stagflation in terms of people's thinking to recession in about 2 seconds.
I do think it's going to be hard to avoid, further moves down in the market.
Retaliation may not be just as it relates to tariffs. It may actually be as it relates to investment in U.S. assets.
We're taking a tremendous amount of near-term painful medicine.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P. Near session highs up by 1.5% on the S&P 500. Following a 3-day losing streak, we're higher by 1.3% on the Nasdaq 100. Later on tonight, 1 minute past midnight, 20% tariffs on Europe, 24 on Japan, 34 on China, plus an additional 50 if the president is right and China retaliates, and they're going to go forward with their own 50%. So that's what you confront going into the overnight session over in Asia a little bit later. Equities elevated. That's your day ahead. That's basically it. Is there space to negotiate here, or are these the rules of the game? And the pendulum just swings between one option to the next from day to day. And yesterday there was this belief that maybe there was a door opening to negotiate.
Then it's partly because of the rhetoric. It's partly because of headlines, justified or not. But there has been a shift in tone. And that, I think, is what a lot of people are keying in on. Scott Besson talking about how that there are negotiations and there are things beyond tariffs. You've got Peter Navarro saying absolutely not. Mixed messages seems to be the course. But there is, on the margins, just a bit of a tone shift.
So we reflected on a conversation that Anne-Marie had with the Treasury Secretary on April 2nd when these tariffs were first announced. And we sat here around the table and we said, we felt like Secretary Besson just wasn't in the room. He sounded frustrated in the conversation. And now we're hearing reports in the last 24 hours from Politico that Secretary Besson is back in the room and his strategy is to get the president to suggest he's open to negotiations.
What I take from all of this is that following that announcement, the vision the Treasury Secretary had was shut down. And the real tariff hawks like Peter Navarro and the Commerce Secretary Howard Lutnick won out, at least from the beginning. Potentially, the president doesn't like what he's seeing, and now the Treasury Secretary is going to have a hand in this, and he is going to lead his vision, which is start from a maximalist position, but negotiate towards lower tariff rates. And something interesting, on the way down to Palm Beach this weekend, we were gathering with the president, who was standing behind him, Howard Lutnick. On the way back from Palm Beach to Washington, D.C., who was standing behind the president? Scott Besson.
A subtle shift, Lisa, in the last few days. Look, this can shift back. I want to keep going back to this quote from JP Morgan. The fate of the equity market is essentially in the hands of one individual who can unilaterally ease or deepen this shock. It's in the hands of the president.
Do we really think we're going to get some kind of resolution by midnight tonight? Part of the problem is that if you have, and you're shaking your head, Emery, I think a lot of people would agree with you, the answer is no. And really the issue is, how do you plan a business strategy? How do you plan an investment? Especially at a time where you do see whipsaws of $2.5 trillion in 15 minutes. It becomes very difficult if you're managing money for somebody else to have any kind of conviction with any kind of strategy if it moves on a headline that might or might not be justified.
Fake rumors and wild swings. What a start to the week. Equity futures on the S&P 500 up by 1.5% this morning. Coming up this hour, we'll catch up with Julian Emmanuel of Evercore as investors brace for sweeping tariffs to kick in. Dan Stuyven of Goldman Sachs on a second cut to their all forecast in less than a week. And later, the chair of the White House Council of Economic Advisors, Stephen Myron, joins us later. Looking forward to that conversation. We begin this hour with stocks pushing higher as markets look for signs of policy clarity. Julian Emmanuel of Evercore cutting his year-end price target on the S&P to 5,600 from 68, writing the following: prolonged uncertainty has raised asset volatility, damaged confidence, and increased the odds soft data eventually infects the hard, causing stagflation or outright recession. Julian joins us now for more. Julian, good morning.
Good morning.
Why are you so bullish? Even with the price target cut, based on what we've seen over the last few days, where does the bullishness come from?
The bullishness comes from an expectation that if we look at the last couple of weeks, we have arrived at the point of maximum uncertainty, okay? And it's like, whether you think about it in terms of market volatility, uncertainty measures, frankly, tariff rates, which is the crux of where the uncertainty is from, all these things really aren't sustainable in the long term, because what ends up happening is you get the recession scenario. And I think as an investor, you have to believe a couple of things here. You really have to believe that uncertainty is arriving at peak, and you have to believe, and we do, that Washington has no desire to precipitate a recession, because frankly, precipitating a recession has a lot of other knock-on unintended consequences.
None of us can get into the minds of the president. I've got no idea what he's thinking this morning, going ahead to the tariffs that will kick in overnight. Can we touch on valuations? What's the forward multiple on the S&P right now?
It's well over 20 still.
Does that speak to maximum uncertainty?
It does not, okay, but we have maintained this for 2 years now, and it's certainly worked reasonably well over the last 2 years, is that valuation alone doesn't end a market cycle, okay? What ends a market cycle is an oncoming recession, an uncooperative Fed, or bond yields moving higher. And if we think about the last couple weeks, look, there have been two significant wins here. Number one, oil prices are a lot lower than I think any one of us would have expected. Agreed. Given the fact that Russia and Ukraine is still in escalation mode, and the Middle East is still in escalation mode for the most part. And bond yields have also come in.
You went through three things, and I was just thinking, tick, tick, tick. Fed's showing no willingness to step in. Yesterday, bond yields were higher. What's the circuit breaker for?
So you have to differentiate between a Fed willingness to step in and a Fed who's going to say inflation, which now, in our view, is in the mid-threes for 2025. I don't think he's going to remove the word transitory, because, and our research shows that essentially the real threat is less inflation. It's the one-time hit from wherever we go, and our operating view is that tariffs will actually settle in around 15 to 16% on a global weighted basis, call it by the end of the third quarter. That's how investors can live with it going forward, but that the real threat is the new tariff regime slowing growth perhaps even more.
Is it overly complacent to view this as just business as usual? To not really consider a structural change that frankly is the goal of this administration that could potentially reorder trade and potentially cause a decoupling between the U.S. and China?
Well, again, in 80 days, you're trying to remake a global trading system that took 80 years to build. So to call it business as usual, would be someone who perhaps didn't take defensive measures to his or her portfolio in the last number of weeks. And the question is, are we going to get, and I think Secretary Bessent was right and proper in making the point that there needs to be more singing from the same hymn sheet and an openness to cut deals.
One of the big concerns yesterday was what happened in the bond market. And we were talking about it. A lot of people called me. They said, what are you hearing about this? People didn't have an understanding, but it spooked people. You saw the biggest sell-off in 30-year bonds going back to the pandemic. And why? I don't know. Maybe because of disruption, maybe because of basis trades, maybe because of foreign selling. At what point does that type of disruption fundamentally spook you? And frankly, your bullish call for gains by the end of the year?
Well, actually, at this level of yields, perfectly reasonable. Now, again, remember, part of what we're saying is that asset price volatility all over the place is much larger. So if we're ranging between 390 and 430 or 440 or so in the 10-year yield, that's okay. We live with the volatility, but on balance, that is a rate for forward discounting of share price multiples that we can live with. It's the question is, what was behind yesterday's selling? We don't buy into the fact that it was international investors dumping bonds. We buy into the fact that logically, if you think about it, given the moves that we've had in the last several weeks, it's asset allocation.
But to me, the idea that one headline could drive $2.5 trillion of value destruction and creation over, again, just a blip, that's emerging market-like trading. That is not the deepest, most liquid market in the country, in the world. That is not what we're used to, and that is not the reason why people go to the United States on a risk-adjusted basis that completely undermines the whole premise of the U.S. market. Why does that not shake your confidence that there can be the same kind of dynamic going forward of some sort of American market exceptionalism?
No, you're absolutely right about that, Lisa, and that drives home the point that we have to have, I wouldn't necessarily call it off-ramps, but we have to understand what the path forward could look like to be able to deal with and make assumptions and make capital allocation decisions, whether you're an investor or a corporate, and that's why the emerging policy has to have a direction of travel to where we've maxed out on uncertainty, we've maxed out on potential tariffs, and we are going to get in the art of the deal mode. That's why, again, given this incredible volatility that we've seen in asset markets, which does undermine confidence, the month of April is as important as it is to sort of subdue the feeling in markets. And to the good, we would say, if you look at it, the bearish sentiment is as intense as I've ever seen it, going back to the financial crisis in 2008. You look at the share volumes the last 2 days, off the charts record share volumes. That tends to happen closer to trend changes than trend continuations. So, it's almost getting to a point where it's so negative that at least there's a ray of sunlight.
You offered up a timeline. The end of the third quarter, you think tariff rates could come down anywhere between 10 to 16%. So basically for back to school. What about all the damage that could be done between different administration officials singing from different hymn sheets between now and the end of September?
Well, that's the critical issue. And again, that's why I think, Treasury Secretary Bessent is trying to get people to sort of come together on this. And to the extent that it does or it doesn't, it really will be reflected in asset prices. But, the shock that we've had to the system over the last month, and in particular the last week and a half, is such that you're in the zone where the sentiment data could materially infect the hard data. And to your point, in home selling season, which we're in the peak of right now, and then back to school, et cetera, that's where the economic risk lies.
Larry Fink told Eric Shasky yesterday at the Economic Club in New York that the CEOs that he speaks to think we're already in a recession. I just wonder what we hear from the CEOs on Wall Street on Friday when the earnings come out. What do you think they're going to tell us?
I would think that Jamie Dimon will warn the way he has about policy implementation and uncertainty. And look, this is going to be an earnings season where, you know, it's sort of similar to the unemployment report on Friday. It doesn't matter what the numbers are. It absolutely doesn't matter. What matters is the level of expressed, you know, uncertainty, and, you know, will companies pull their guidance? And I'm sure there are a few that will.
Yeah, Julian, it's good to see you. Thank you, sir. Thanks for dropping by. Julian Emanuel there of Evercore. It's so bad it might be good. Seems to be the argument. I'm joking. Seems to be the argument from some.
Well, from some, there is this idea that who would want to do this to the system, so they'll have to have an off-ramp. If they don't, I guess that's the real question. What if they don't, and how prepared is the market?
Yeah, it's so bad that people don't think they'll go through with it.
Right.
Yet here we are with additional tariffs over the weekend, a baseline tariff of 10% on overnight. We're going to have additional tariffs, 20 on Europe, 24 on Japan, 34 on China, and maybe even another 50.
Maybe need another 50, which means cumulatively we're looking at, for some products, more than 100% tariffs when it comes to Chinese imports. I go back to what Kellyanne Shaw told me yesterday in Washington, and she was part of the trade negotiations and Trump won. She said, you need that uncertainty. That ambiguity is on purpose, because that is how Trump is going to extract maximum concessions at the negotiating table.
Well, we've certainly got a lot of that right now. Equity futures on the S&P bouncing back by 1.3% with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Supreme Court has allowed President Trump to resume deporting alleged Venezuelan gang members under the Alien Enemies Act. The court granted the emergency request in a 5-4 vote. The court ruled that detainees must have notice and a chance to make their case to a judge before deportation. House Freedom Caucus Chairman Andy Harris says that he is open to the creation of a new 40% tax bracket for those earning $1 million or more. Republicans have long opposed any form of a tax increase, but the Freedom Caucus has the power to block a thin Republican majority in the House as it tries to pass new tax cuts amid fiscal constraints. Chinese auto giant BYD said its first quarter profit could more than double after a bumper start to the year that saw vehicle sales top 1 million. The company said total sales through March are 60% higher than a year ago, and its overseas expansion achieved leapfrog growth in the quarter. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny later on this hour. Up next on the program, open to negotiations.
For countries that don't retaliate, we are at a maximum tariff level, and it is my hope that through good negotiations, all we will do is see levels come down.
Up next on the program, the reaction from the Cato Institute. We'll catch up with Alex Norista from New York City this morning. Good morning.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
Bloomberg has has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
The worst three-day slide since the pandemic, and attempted to snap it this morning, up by 1.6% on the S&P, on the Nasdaq 100 up by 1.4, on the Russell up by 2. And the surveillance this morning open to negotiations.
For countries that don't retaliate, we are at a maximum tariff level, and it is my hope that through good negotiations, all we will do is see levels come down. But that's going to depend on the other countries. And President Trump is going to be personally involved in these negotiations. And he believes, as many of us do, that there's been an unfair playing field. So the negotiations are going to be tough.
So here's the latest this morning. The Treasury Secretary Scott Bessent saying everything is on the negotiating table when it comes to tariffs. Bessent saying deals will likely not be done before additional tariffs kick in at 12:01 a.m. tomorrow morning. Bloomberg's Tyler Kendall